Okay, good morning everyone. Welcome to Byju's Exam Prep IAS. This is Sham Kagodia. Now, before I start the discussion, if there is no issue with the sound, can you please let me know? Give me a thumbs up so that we can start. Done. Thanks a lot. Let's start. So last week, what we have done, we started with the concept of financial market. Correct. We started with the idea of a financial market. What's a financial market? It's a market where instruments are traded. Traded in the sense the instruments, which could be short term in nature or long term in nature, doesn't matter. These instruments are either bought or sold in the market. That market is called as a financial market. Now, the financial market, based on the duration of the instrument or based on the requirements of the borrowers, etc., whether it is for a short duration or for a long duration, we divide this market into two parts. One is called as a money market, second one is called as a capital market. And what is the difference between a money market as well as a capital market? In money market, the instruments which are traded are short duration. Any example of this, right? Commercial bills, commercial papers, certificates of deposits, etc. Or for that matter, even the treasury bills, repo, reverse repo, etc. And after that, we have discussed the concept of the capital market. Capital market is what? Capital market is a market where instruments which are traded are of a longer duration or a medium duration. And when I say longer or medium duration, the duration of these instruments will be more than 1 year. That's a basic idea. And in money market, the funding requirement is for working capital, whereas in the capital market, the funding requirements is for capital formation or investment purposes. Then we have individually discussed what are the tools under the money market. Individually, all the tools we have discussed. Then we shifted to concept of capital market, and we had discussed certain types of bonds. For example, convertible bonds, non-convertible bonds, right? These again, apart from that, we have also discussed the concept of zero coupon bonds. Now we are supposed to continue the discussion. Let's start. Next type of bond that I want to discuss is the concept of indexed bond. Indexed bond. Now, what is this idea of an indexed bond? Please understand. The returns on these bonds, which are given to the investors, the returns, that is the interest rate or the coupon rate that is given to the investors, it is connected or indexed to a particular price index. For example, many of you ask me, sir, what do you mean by price index? What do you mean by connected here? Let me give a very simple example. Imagine, I'll start with this example. Listen to me very carefully now. Imagine I will issue this bond to you. And what is the coupon rate here? Coupon rate on the bond is 6%. Now, what if I tell you? From this year to the next year, as the inflation changes, I'll repeat the statement. From this year to the next year, as the inflation changes, I will automatically adjust your coupon rate. I'll repeat the statement. Listen carefully. I'm issuing this bond to you, and the coupon rate on the bond return is 6%. I am telling you, from this year to next year, after 1 year, I'm supposed to give you 6% of 100. That will be 6 rupees. But I'm telling you, as the inflation will change, as the price levels will keep on changing, I will also adjust your coupon rate. And now please tell me, can I call such bonds where the returns are connected, returns are indexed, linked to a parameter? Can I call such bonds as indexed bonds? All of you okay? Can I call such bonds as indexed bonds? For example, look at this particular table. Do not by heart the calculation, but please understand the concept behind it. What does the table represent? Imagine a bond has been issued, a bond, inflation indexed bond. Imagine inflation indexed bond has been issued in the year 2020. So you gave 100 rupees and you purchased the bond, and the issuer had guaranteed that annually they will give you 10% coupon rate. Assuming the bond has a tenure of 2 years. assuming that the bond has a tenure of 2 years, see how the calculation will be done. So after 1 year, let's say coupon rate of 10% is supposed to be given to you. But between 2020 and 21, there is an inflation rate of 6%. Between 20 and 21, there is an inflation rate of 6%. So the issuer who is supposed to give you the coupon payment, rather than simply giving you 10 rupee, will increase the coupon rate by 6% and give you 10 rupees 60 paisa. All of you okay? Why it will become 10 rupees 60 paisa? Because from 20 to 21, inflation rate is 6%. So the issuer will obviously give you additional 6% in the form of coupon rate. So 10 rupees 60 paisa. And let's say after 1 more year, so again there is inflation of 10% compared to base, there is an inflation of 10%. So the issuer will increase your coupon rate. Rather than simply give you 10 rupee, they will add 10% because the inflation rate is 10%. So 10 rupee plus 10% of 10 rupee, that will become 1 rupee. So you will get the coupon of 11 rupees. And assuming the bond will mature in the second year, again assuming the bond will mature in second year, your principal amount will also get adjusted by 10% and you will get 110 rupees. So now please do let me know, all of you okay with this idea of an inflation indexed bond? Do we issue inflation indexed bond in India today? No. Government of India tried it earlier, did not become very famous in India, and that's the reason right now we are not using any kind of inflation indexed bonds. But let me go one step forward here. This question was asked in UPSC. Now, please tell me, you think of it, please tell me, if you are issuing an inflation indexed bond, I repeat, think of it very carefully. If you are issuing an inflation indexed bond to me, is it okay if I say I am taking lower risk by investing in an inflation indexed bond compared to any other bond where there is no inflation indexation? All of you okay with this? Right? Again, I'll repeat the question. Think of it, I'll repeat the question. You are issuing this kind of a bond where the returns are connected to inflation. If I am investing in this, can I say by investing in such bond, can I say I'm taking lower risk compared to investing in any other bond where there is no inflation indexation? Because I am getting certain comfort here. I'm getting certain security. Security against what? Security against the threat of inflation. Now you please tell me, if I write 2 bonds here, you please tell me bond 1 where there is an inflation indexation. Where there is inflation indexation, and a second bond where there is no inflation indexation. According to you, which of the 2 bonds will offer higher coupon rates? Think of it. There is one bond which will provide you inflation indexation and second bond which will not provide any kind of inflation indexation. According to you, coupon rate, I'm not saying after inflation adjustment, think of it, coupon rate, which will offer, or the issuer, whoever is issuing it, where should the coupon rate offered be higher? My dear, some of you are correct, some of you are not thinking correctly. Early morning, new year, wake up now. It should be second bond. It should be second bond. Think logically, it should be the second bond. Why? By issuing a second bond or by purchasing a second bond, let's say you are purchasing second bond, are you not taking a higher risk? Correct or not? By purchasing a second bond, are you not taking a higher risk? How higher risk? Here, there is a adjustment. There is a guarantee that whatever is the inflation, your returns will be connected to inflation. But by investing in the second bond, there is no adjustment to inflation. Are you not taking a higher risk by investing in the second bond? So please remember this. Coupon rate offered in the second bond would be greater than coupon rate offered in the first bond. All of you okay? All of you okay with this? Coupon rate offered on the second bond would be higher compared to coupon rate offered on the first bond. Right? So that's a basic argument. Now, this is the statement that was asked in UPSC. Think of it. I'll give you a statement. Can government of India, I repeat, can government of India reduce its cost of borrowing by issuing inflation indexed bonds? Can government of India reduce its cost of borrowing by issuing inflation indexed bonds? Right? That is basically, can government of India issue inflation index bonds and reduce the cost of borrowing? That is basically the rate of interest. Can they borrow at lower rate of interest by issuing bond one? Answer is yes. Of course, yes. This was the question asked in UPSC. Answer is simply yes. Why? Please understand, many of you will simply say, but sir, in bond one, inflation indexation will take place. Are you sure how much will be the inflation in the next 1 year? Think of it. Are you sure in the next 1 year how much will be the inflation? What if I say, right? Think of this. What if I say bond 2 will be issued at 10%? Bond 2 is issued at a 10% coupon rate, and bond 1 is issued, let's say, at 8% coupon rate. At 8% coupon rate, and promising that, okay, whatever is the inflation, I will adjust with inflation. Which means if inflation is 10%, you will get a coupon rate of how much? 8.8%. You get a coupon rate of 8.8% after adjustment. So even then, by issuing bond 1, right, the government of India is very safe. So I hope you understand this. Government can reduce its cost of borrowing by issuing the inflation index bonds. But we are not issuing it now. We are issuing generally the normal bonds. Normal bonds. Okay, can we go forward now? This is a concept of indexation. It is a concept of inflation indexed bonds. And can there be a vice versa situation? Can there be vice versa? So you are assuming inflation rate of 10% rather than 8%. What if the bond was issued at 9.5%? Rather than 8%, what if the bond was issued at 9%? Of course, yes. Right? In that particular case, government will end up paying more coupon rate compared to, let's say, a normal bond. Again, it's a risk and return hypothesis. Okay, it's basically a risk and return hypothesis. Okay, so this is basically the concept of inflation indexation or indexed bonds. So one, convertible, non-convertible, right? Indexed bonds, zero coupon bonds, and next one, concept of sovereign gold bonds. Sovereign gold bonds. Now, please tell me, how many of you did read the newspaper yesterday? How many of you did read the newspapers yesterday? Right, New Year, right? I know most of you are celebrating New Year, but how many of you are able to read yesterday's newspaper? And correct me if I'm wrong, was there an article, very big article on sovereign gold bonds yesterday in Hindu newspaper? In Hindu newspaper, was there a very big article on the concept of sovereign gold bond? Now understand what is this idea of a sovereign gold bond. Today you will go to the market and purchase, let's say, 10 grams of gold. Understand this carefully. Today you will go to the market and purchase 10 grams of gold. 10 grams of gold. Now, when you purchase 10 grams of gold, can I say, one, you'll be concerned about safety of the gold? Correct? You'll be concerned about safety of the security of the gold. Second one, you'll be concerned about purity of the gold. Yes or no? You'll be concerned about purity of the gold. That is, you're purchasing, you're no doubt you're paying 60,000, 65,000, whatever the gold price is. But you're concerned whether this gold is right purely, let's say, 99.99% gold, or 22 karat gold, or 18 karat gold as promised by the seller. So you're worried about security of the gold. You're worried about purity of the gold. Third one, you'll purchase gold. Please tell me, this physical gold, will it give you any kind of interest returns over a period of time? I hope you understand my statement. You'll purchase a gold. Do you think the gold will give you any kind of interest returns over the period of time? Absolutely no. Interest they will not give you, right? Just because you have purchased gold, nobody will give you interest. So the government of India says these are the concerns. And moreover, fourth important point, lot of gold that is consumed in India is imported into India. Lot of the gold that is consumed in India, it is imported into India. So when you keep on importing gold and keep on consuming it in India, Don't you think import dependence will be very high? Dollars will be going out of India. That might create a lot of pressure on the exchange rate, etc. So now to address all of these, to address these kind of issues related to physical gold consumption, Government of India has launched a tool or an instrument, a type of government bond called as sovereign gold bond. Called as sovereign gold bond. Yes, GB, sovereign gold bond. Now, what are the features of sovereign gold bond? Point number one, anybody can purchase a sovereign gold bond. You can purchase, I can purchase, a household can purchase, Hindu undivided family can purchase, anybody can purchase a sovereign gold bond. So how much should be the minimum investment? Minimum investment is 1 gram. You can simply purchase a sovereign gold bond which is equivalent to 1 gram, and maximum from one type of buyer to another type of buyer, the maximum quantity allowed will keep on changing. That is point number two. Third point, third very important point, what is a sovereign gold bond? I'll take a very simple example. Imagine this is a bond. Imagine this is a bond. Government will call this as a sovereign gold bond. And what is the use of a sovereign gold bond? If you purchase the sovereign gold bond today, you will have to pay whatever is the market price of gold in India. Is it okay? I'll repeat the statement. Understand the statement carefully. If you purchase a sovereign gold bond, let's say 1 gram, imagine this is worth 1 gram of sovereign gold bond, you will have to pay whatever is the market price of 1 gram gold today. And these sovereign gold bonds will have a maturity period of 8 years. These sovereign gold bonds will have a maturity period of 8 years. Upon maturity, let's say hypothetically today you have purchased, which is 2024. So after 8 years are over, at the end of the 8 years, whatever is the market price on that day, I repeat, whatever is the market price of the gold on that day, government will repurchase it or buy it back from you, and government will give you the market price of the gold on the last day, that is at the end of 8 years. And not just this, if you purchase the sovereign gold bond, you can sell it to me. Is it okay? You can sell it to me. And when I purchase, what will be the price that I'll pay? I'll pay whatever is the price of gold on that day. But please understand, generally government will say you will have to hold on to this for at least 5 years, and only then you can allow, or you are allowed to sell it in the market or trade it in the market. Now, next point. Sir, what is any advantage? Is there any advantage of buying this particular sovereign gold bond? Government says, if you purchase a physical gold, if you purchase, let's say, gold bar, gold jewelry, etc., you're worried about purity. This is a bond. This is a bond whose price is connected to market prices of gold. You do not have to be worried about purity of this bond. Point number one. Point number two. You will purchase physical gold, you have kept it in a home, and you are, let's say, in Europe, you are in Australia, you are in other part of India, you're worried about, let's say, if somebody will break into your home and take away gold. And every now and then you'll keep on calling your friend, your neighbor, your relative, and you'll keep on pestering them, right? Has anybody broken into my home? Please check, is my lock still there, etc., etc. Now government says, instead of buying, let's say, 50 gram of gold, purchase sovereign gold bond worth 50 gram. No worries about security. No questions about security here. Why? Please understand this. Many of you start asking me, sir, what if I lose this bond? Because I'm showing a cardboard here. Many of you ask me, what if I lose this bond? Please understand, from 1996 in India, we have introduced the concept of dematerialization. We have introduced the concept of dematerialization. Now, what is this idea of a dematerialization? Materialization means giving a physical form. Materialization means giving a physical form. Many of you will come across these, right, let's say, statements, or let's say when you're going through YouTube videos or shorts, saints will keep on telling you, don't be materialistic. Don't be materialistic, meaning what? Don't run behind things which have got physical forms. Materialization means giving a physical form. Dematerialization means no, there is no physical form of it. We are giving in a digital form. For example, please tell me, Have you heard of demat accounts? Please do let me know. Have you heard of demat accounts? Many of the banks are offering demat accounts now. Many of the stock brokerages are offering demat accounts. Many of you would have received a message promoting demat accounts, etc. Now understand this very carefully. What do you mean by demat account? You want to trade in the stock market. You want to trade in the stock market, or you want to trade in a bond market. Earlier, before 1996, what used to happen is, if you purchase a bond, imagine if you purchase this bond physically, that is, this kind of a paper used to be given to you. All of you okay with this? All of you okay? Right? Earlier, before dematerialization was introduced, if you purchase a bond, if you purchase this bond, I used to literally transfer this physical bond to you. That used to happen. If you purchase shares, physical papers used to be given to you. But post 1996, what we have done? We have discontinued this practice. Now, any purchase of shares, bonds, etc. that you do, everything will be in a digital form. All of you okay with this? Everything will be in digital format. That is, you will open an account. You'll open a demat account. If you purchase shares, the shares will get added to demat account, just like a bank account. At least now tell me, all of you have seen bank accounts online? Not offline, online. Have you opened your mobile wallet, or let's say mobile banking account, and checked whether the money has been transferred or not? When you transfer, minus, right, let's say debit. When you will receive it will say plus credit, like this. Imagine the same way. Imagine you have a demat account. You will sell this particular bond to me. Digitally, the bond will be transferred into my account. You will purchase a shares of Adani company. Digitally, the shares will be transferred into your demat account. That is a concept of dematerialization. All the instruments have been dematerialized in Indian market today. All the instruments, bonds, shares, etc., all of them have been dematerialized. Now, please tell me, if the bond, that is a sovereign gold bond, is dematerialized, can I say security wise, safety wise, it is much better compared to physical gold? All of you okay? Security wise or safety wise, it is much better compared to physical gold. That is one more advantage. Third very important advantage is, whatever is your investment in the bond, I'll repeat the statement. Whatever is the initial investment means, when you paid and purchased the bond, what was your investment when it was issued by the government? On that investment, annually government will give you 2.5% interest rate. Is it okay? Whatever was the initial investment, that is when government issued the bond, sold the bond, and you purchased, whatever was the initial investment, on this 2.5% interest annually will be given by government. Okay, right? So these are certain very important instruments, or let's say features, associated with the sovereign gold bond. And please understand, some of you might be thinking, sir, very interesting, then I will invest in this, etc., etc. Understand, against other instrument, right? For example, you can purchase this bond, you can sell it at any point of time. You can purchase this and you can sell it at any point of time. But if you invest in a sovereign gold bond, there's a lock-in period of 5 years. You'll have to have this particular bond for 5 years. And the returns, that is the final price, that is whatever the market price of the gold after 8 years, you will receive the money only after 8 years, not in the initial time period. But having said so, if you compare the market, sovereign gold bonds, the first tranche was issued somewhere in 2015. The first round was issued in 2015. 2015 plus 8 years. I hope you understand now. 2015 plus 8 years means the first round of sovereign gold bonds have matured now. All of you are able to understand this, right? The first round of sovereign gold bonds which are issued by government already have matured. On an average, how much interest have they provided to the investors in terms of returns? I'm talking overall returns. On an average, how much is the interest provided, returns provided by these sovereign gold bonds to the investors? More than 10% per annum. I'll repeat the statement. On an average, the sovereign gold bonds, the first round of sovereign gold bonds, have provided more than 10% returns to the investors, right, per annum. 10% per annum is a very, very good interest rate or returns rate. 10% per year is a very, very good returns. Please understand this. It's a very, very good returns comparing what has happened in the market in recent times. Okay. And finally, right, look at the last point here. These securities are eligible to be used as collateral. They can be used as collateral, right, to get the loans from banks, NBFCs, etc. Right, banks, NBFCs, etc. Okay, so these are certain very important features associated with the sovereign gold bonds. Sovereign gold bonds. Can we go forward now? Can we go forward? Sir, you said 2.5% per annum. My dear, that is interest. You will purchase at, let's say, you will purchase a sovereign gold bond 1 gram by paying 2,500 rupees, and after 8 years, you will get 4,000 rupees. Can you calculate the returns rate on this also? Think of it, right? You will purchase 1 gram sovereign gold bond at 2,500, and after 8 years, for the same 1 gram, government will give you 4,000 rupees. So can you calculate the returns rate on this also? Of course, yes. Okay. What if we don't want to sell it after maturity? My dear, it's a bond. There is no question of selling after maturity. Please tell me, after 3 years, don't you think automatically this bond will become mature? There is a question of selling. There is a question of selling here. The bond becomes mature. You will have to return it and get the money back. It's basically a bond. Why is inflation adjusted to coupon rate and not principal? Please check the calculation. Inflation is adjusted to principal also. The issuer will decide what in adjustment they will do it. Okay. Sovereign gold bonds returns is confusing. Once you're saying this, once you're saying that, my dear. Right? Imagine this is sovereign gold bond. Again, don't worry about 6%. Don't worry about this. Imagine today, understand at least now. Imagine today for 1 gram of gold, it is 100 rupees. I'll repeat. Imagine today for 1 gram of gold, it is 100 rupees. So you will purchase this 1 gram sovereign gold bond, you will pay 100 rupees. So now government will give 2.5% per annum on 100 rupees. All of you okay? 2.5% per annum on this 100. That is your annual interest that you will earn. Upon maturity, after 8 years is over, let's imagine 1 gram of gold is equal to 300 rupees. So government will purchase this bond from you and will give you 300 rupees. So you have earned 2.5% annually, plus you also have earned 200 rupees extra. Right? And upon 200 rupees, automatically government will impose capital gains tax. Okay? Done? Okay, let me go forward. Simply you're complicating all the concepts. Please listen carefully. Listen carefully whenever I discuss. Next concept I want to discuss is green bonds. What is this idea of a green bond? Very simple. Green bonds are those debt instruments which are issued. The money that is borrowed will be used only for environment friendly projects. Very, very simple. Listen carefully. Green bonds are those types of instruments, debt instruments, when they are issued, the money that is collected will be used only for environment friendly projects. Now, many of you ask me, sir, what do you mean by environment friendly projects? As per India, they will classify such projects as environment friendly projects. For example, I will issue a green bond, I will collect money, I will use it for, let's say, wind energy project. I will use it for solar energy project. I will use it for cleaner transportation. I will use it for sustainable water management project, etc. Right now, again, don't start asking me, tell me what you mean by climate change adaptation. Tell me what you mean by sustainable water management. Right? All of these will be discussed, and I'm pretty sure already discussed in your environment classes. So argument is very simple. Look at the name of the bond, green bond. Green bonds are those bonds which are issued. The money that is borrowed will be used only for the purposes of investment in a project which are climate friendly, which are environment friendly projects. Now, who can invest or who can issue these particular green bonds? Let's start with who can issue, then we can discuss who can invest. So these can be issued by the government. They can be issued by the government. For example, Government of India last year has issued sovereign green bonds. Government of India has issued sovereign green bonds. It has already been done. Can be issued even by the government owned authorities. Can be issued even by government owned authorities. For example, in India, National Highways Authority of India has issued green bonds. But please tell me, think of it and do let me know. National Highways Authority of India, if they issue a green bond, can it be called as a sovereign green bond? Because many of you will keep on asking me what is the difference between the government and, right, let's say government owned agency. If Government of India will issue a green bond, then it is called as a sovereign bond. Then it is called as a sovereign bond, a sovereign green bond. And if any authority owned by Government of India issues, no, these are generally bonds. These are called as green bonds, not sovereign. Sovereign means government. Sovereign always means government. Okay. So government owned authorities or entities, private sector companies, for example, Ford, right? All of you heard of company Ford? FORD. Company Ford has issued green bonds, and they've told that we will use this money for promotion of electric vehicles. So Ford company, a private sector company, has issued green bonds. And multilateral organizations, and for example, World Bank also issues green bonds, right? So these are some of the issuers who can issue or who are allowed to issue green bonds and who are allowed to invest. Generally, the investors might be foreign investors, domestic investors, or banking sector, other financial institutions, etc. Many of them are allowed to invest and purchase green bonds. Now, funds raised through this route are earmarked only for certain projects. For example, let me know. Think of it and please do let me know. I am telling you, I repeat, I am telling you, this is a green bond. Please give me 100 rupees. I want to invest in a solar project. I'll repeat the statement. I'm issuing this particular bond to you, green bond. I'm telling you, I will borrow this 100 rupee and I will invest in a solar project. Now, please tell me, can I use this 100 rupees to invest in any other projects? Should it be allowed? Can I invest this 100 rupee to purchase a machine? Can I invest this 100 rupees to set up a manufacturing facility? To purchase one more company? It will not be allowed. It will never be allowed. Right? So that is the reason annually, whenever such bonds are issued, external agencies, right, auditors, etc., are hired. They will publish a report stating for what purposes they have raised the funds, have they utilized the funds, how much funds they have utilized, what is the progress of the project, etc. All of these auditing measures are in place. Now let me go forward. Whenever you talk about green bonds, there's a term called as greenium. Whenever you talk about the concept of green bonds, there's a term called as greenium. What do you mean by greenium? Please understand this. Greenium is a combination of two terms, green plus premium. It is a combination of two terms, green bond plus premium, greenium. Now, what is this idea of a greenium? Let me explain it. Please listen to me very carefully. What is the face value of this bond? What is the face value of the bond? Can I say face value of the bond is 100 rupee? Face value of the bond is 100 rupee. Now, if the face value of the bond is 100, if I issue the bond at 90 rupees, can I call this as issued at discount? Simple, right? The face value is 100. If I issue this at 90 rupees and collect 90 rupees from you, can I say the bond has been issued at a discount? Answer is yes. Second, if the face value is 100, and I will issue this at 103 rupees, I will issue the bond to you at 103 rupees, Can I call this as premium issue? Anybody has a problem? The face value is 100. I've issued it at 103 rupees. Can I say I've issued this bond at a premium to you? Now, point number two. Point number two. Do not worry about maturity period. Please look at it very carefully. Point number two. Face value is 100. Coupon rate is 6%. If I issue this at 103 rupees, can I now say I will be incurring less interest rate? My cost of borrowing will be lower. Anybody has a problem? I'll repeat the statement. The face value of the bond is 100. Please listen carefully. Face value of the bond is 100. I will issue this at 103 rupees to you. I will issue this at 103 rupees. Can I now say my cost of borrowing has become lower? Anybody has a difficulty if I say my cost of borrowing has come down? Those who are asking, sir, why my cost of borrowing will become lower? It is very difficult to understand. It is very confusing. In example 1, imagine you will issue at 100, you will pay 6 rupees, your cost of borrowing will become 6%. Correct? Imagine the bond is worth 100 rupees, you will issue it at 100, and after 1 year you will give 6 rupees, your cost of borrowing will become 6%. On the other side, instead of 100 rupee, if I give you 103, if I sell it at 103, and after 1 year, I'll give you 6 rupees because the coupon rate is 6 rupees. And 6% of 100, 6 rupees. Please do let me know. Can I say now cost of borrowing will be less than 6%? All of you okay? My cost of borrowing will be less than 6%. This process, I repeat, this process of reducing the cost of borrowing by issuing the bond at a premium pricing is called as greenium. I'll repeat the statement. This process of issuing a bond at a premium price, issuing the bond at a premium price and reducing the cost of borrowing is called as greenium. It is called as greenium. And those are asking how, my dear, don't you remember yield rate, coupon rate, etc.? Please tell me. Again, this is, as far I don't want to take the names of the students, but this is very bad. You people are, some of you are not revising anything. Please tell me, coupon rate is calculated on the market price or the face value? Those are asking how, right? Explain it. Very confusing, etc. Coupon is calculated on the face value or any other price? Let me know. It is calculated on the face value. And what is the face value of this bond? What is the face value? 100 rupee. So if you purchase this bond at 103, you purchase it at 105, you purchase it at 102, how much will you get? You will get 6 rupee. You will get 6 rupee. So you will get 6 rupee by investing 103 rupee. What is the actual cost of funds? Calculate. Take out your calculator. 6 rupee divided by 103 rupee. I've collected 103. I'm giving you 6% of face value, 6 rupees. Can I say for me, instead of incurring a cost of borrowing of 6%, now it will be less than 6%. That is basically the idea. Right? So I hope you understand the logic behind it. So green plus premium, it is called as greenium. Green plus premium is called as greenium. Right? Very important regarding green bonds. Please be very careful. Now, Government of India is issuing green bonds. Very recently, Government of India has started issuing green bonds. Right? Very important. Why? Please tell me. Can I say, if UPC will ask you a question, let's say, discuss the reforms undertaken by the government to achieve net zero by 2070. I hope you understand. Discuss the reforms, discuss the measures undertaken by the government to achieve the goal of net zero emissions by 2070. Can you write this as one of the reforms? Let me know. Can you write this as one of the reforms? Right? Of course, as you will have to write this as one of the reforms. Please remember this. You may not come across this concept in any other book, right? But in economics, you have read it. Use it in writing answers even under the ecology paper. Okay. Why will people pay premium? Who will get the benefit? My dear, please tell me, if you want to promote sustainable growth, if you want to promote environmental protection, don't you think you should ensure that the loan or the borrowings are available at lower interest rate? Does it make sense to you or not? I'll repeat it again. Point number one, all of us, right, including other governments, COP, Conference of Parties, etc., all of us want to protect our environment. Now, to protect our environment, we should ensure that infrastructures which are environment friendly should be promoted. And how can you promote infrastructure that is environment friendly? By ensuring that cost of funds on such borrowings is lesser. By having a greenium concept, are we not ensuring that? Are we not ensuring that? Of course, yes, we are ensuring. Because please understand the logic behind it. We are not just running behind profits in such infrastructure projects. Environment friendly nature is also one of the very important objectives. In fact, let me ask you a very simple question now. How many of you have come across the term ESG very recently in Hindu newspaper? Let me say, how many of you are actually reading newspapers? How many of you have come across ESG in Hindu newspaper? I'm not even asking Economic Times. I'm not even asking Business Line. Forget about it. I'm just asking you Hindu newspaper. Have you come across the term ESG under Hindu newspaper? It was there couple of days ago. That is, there was one article regarding textile sector. Correct? There was one article couple of days ago regarding textile sector. And they mentioned the term ESG while discussing the issues related to textile sector. What is the ESG? What is the expansion of ESG? ESG stands for environment, social and governance. Environment, social and governance. That is basically the expansion of ESG. The basic idea of ESG is simple. There are certain investors in the market now. There are certain investors in the market who look at ESG component and make investment in the market. Is it okay? It is called as ESG investment. ESG investment. In simple terms, if I am an investor, I will not just look at the profits now. Profit motive is not just one of the parameters for me. I will also see whether the company is environmentally doing anything good or bad. Is the company promoting pollution? Is it causing a lot of pollution? Or it is a company which is more environment friendly? Right? Is the company following, let's say, promotion of women empowerment? Or it is adding to the issues of income inequality? Is the company following a very good governance policy? Are the companies right accounting standards up to the requirement? So there are various parameters which are considered now, which is basically called as ESG investment: environment, social and governance. ESG, right? And that particular context, please do let me know. Because of rise of ESG, can I say companies which are issuing green bonds will already have certain ready-made investors in the market? I'll repeat the statement. Because of rise of ESG investment, can I say a company which is issuing green bonds has already certain ready-made investors, that is certain ready investors in the market to invest in such instrument. Right? So there is a rise of this concept of ESG investments. Please be very, very careful. Okay. Now, let me go to the next one, masala bond. And before I go to the next one, many of you are asking, sir, because you're talking about Hindu newspaper, any article for today? Today's Hindu newspaper, please read about Manrega. There is an article regarding Manrega. Right? Very nice article regarding Manrega, MGNREGs. Right? They can write it as A or S. Right? Act or scheme, Manrega. Okay, so Manrega scheme, there is an article. In fact, you should read this article from today's Hindu newspaper plus 2 more articles in yesterday's newspaper. Right? I'll repeat it. Today's newspaper, but before that, read 2 articles in yesterday's newspaper which were there regarding Manrega only. Regarding Manrega. Now think of it. Please think of it. You will read this book A, read book B, read book C, etc., etc. But if you're reading Manrega article, there is a concept called as right Aadhaar enabled payment system, APS, Aadhaar enabled payment system. Right? Don't you think suddenly UPSC next year might ask a question on Aadhaar enabled payment system? I hope you understand my point here. So that is the reason, please do not stick to only books. Do not imagine that whatever is there in the book, UPSC will ask you automatically. Absolutely no. Whatever is there in the current affairs, they can ask you that as well. In addition to this, today I want you people to read one more article on RBI governor's role. RBI's role in crisis. RBI's role in crisis. There is a very big article regarding one of the former RBI governors, Mr. Venkati Raman, very well-known RBI governor. RBI's role in economic crisis. Very big article in explained section. Please read that also. Some of you are saying, what about the GST news, etc., etc.? I don't think so. That is important. I don't think so. That is important. Why? I'll tell you. The monthly revenue collection of GST is always a headline. The monthly GST revenue collection is always a headline. They have collected more than 1.6 lakh crore rupees. It has become a common, and from one month to another month, the data will keep on changing and data will be published every month. So as far as I'm concerned, that monthly revenue collection of GST newspaper article is not that important. It's not important. What you need to simply remember is the average GST revenue collection, it is higher now. It has increased to around 1.6 lakh crore rupees. Simply remember that. More than sufficient. Done. So let me go ahead with the concept of masala bond. Masala bond. Now, point number one, there is a concept called as external commercial borrowing, ECB. External commercial borrowing. Now, right now, simply understand the concept. What is the definition? Later, we'll discuss in detail. External commercial borrowing. Now, what is this external commercial borrowing? Any company in India, which is allowed to accept foreign investments. I'll repeat the statement. Any company in India which can accept foreign investments is allowed to go to a foreign market, borrow from the foreign market. Is it okay? I'll repeat the statement here. Any company in India which is eligible to attract a foreign investment, take foreign investment, can go to a foreign market and borrow from the foreign market. Right? Borrowing in terms of what? They can borrow by taking loans in the foreign market. They can borrow by issuing bonds in the foreign market. Now, let me be focused on the concept of bonds here. Please do let me know if you are a company which will issue bonds and borrow in terms of dollars, let's say for 5 years or let's say for 8 years, can I say you will face exchange rate risk? Please do let me know. Participate and please do let me know. I want all of you to participate. I'll repeat the statement. You are a company which has borrowed by issuing, let's say, dollar bonds outside India for 5 years, for 8 years, for 6 years, whatever the duration is. Can I say you will face exchange rate risk? That is, you will borrow right when the exchange rate is lower and you will repay when the exchange rate for Indian rupee is higher. In simple terms, today $1 is equal to 50 rupee when you borrow. When you are repaying, $1 is equal to 80 rupee. So you will face exchange rate risk. Now, is there any way to address this issue of exchange rate risk? Yes, there is a way. Under external commercial borrowings, under ECB, now RBI says you can go to a foreign market. And issue bonds which are denominated in Indian rupees. I'll repeat the statement. You can go to a foreign market now. Let's say you will go to USA. You can issue a bond, not in dollars, right? Not required now. You can issue a bond in USA market where the bond is denominated. Denominated means where the value of the bond is given in terms of rupees only. All of you okay with this concept? Such bonds which are issued in foreign markets but in domestic currencies, denominated in domestic currencies, are referred to as masala bonds. In India, I repeat, such bonds which are issued outside India, but denominated in Indian currency, that is rupees, is referred to as masala bonds. All of you okay? Now, please do let me know. Instead of saying outside India, Can I use the term overseas? All of you okay with this? Instead of saying outside India, can I say overseas? Any problem? Instead of overseas, can I use one more term, offshore? Please do let me know if anybody has any problem with this, right? Because in UPSC, they can use any term. They can say offshore instrument. They can say it is overseas instrument. They can say it is issued outside India, right? You don't get confused, right? All of them mean one and the same. It simply means these bonds are issued outside India. So these are offshore debt instruments. These are offshore debt instruments wherein the value of the bond is denominated. It is given in domestic currency, that is rupee. These instruments are called as masala bonds. Now please tell me, imagine you're a company, you will go to USA, you will issue a bond whose value is denominated in rupees. Are you, as a borrower, are you facing exchange rate risk? I'll repeat the question. You will go to USA, you will issue this bond whose value is given in rupees. As a borrower, are you facing exchange rate risk? No, you are not facing exchange rate risk. Some of you are saying, yes, even now. My dear, you will go to USA. Imagine I am the investor sitting in USA. I am sitting in USA. You will come to me. You will sell the bond to me, 100 rupee. You are selling a bond whose value is 100 rupee. And after maturity, you will give me 100 rupee, which means, can I say, as an investor, I am facing exchange rate risk. Everybody is okay with this? Can we go forward? As an investor in a sovereign gold bond, can I say the investor faces exchange rate risk, not the issuer, not the borrower, but the investor will face exchange rate risk. Now, I will automatically say, because I'm facing exchange rate risk, I'm taking higher risk by investing in such instrument. So what you will do? When you are issuing this bond, you will offer me higher coupon rate. Let me know, does this make sense or not? Because the investor is facing exchange rate risk, obviously the risk related to investment is very high. What will you do? Because I am facing higher risk, you will offer me a higher interest rate. You will offer me a higher coupon rate. And think of this very carefully. Some of you will start asking me now, sir, why will the investors invest? Why will a USA investor purchase such a bond? You are going to a market such as USA where interest rate is 2%, interest rate is 3%, and you'll offer that investor 7% returns. You'll offer that investor 8% returns. Don't you think automatically the investors in USA will be attracted to invest in such instruments? So there is a demand. There is a huge demand for such kind of instruments in the overseas market as well. Now, why these are called as masala bonds? Is there any particular reason why these are referred as masala bond? The international convention practice is that whenever you want to name these, right? Whenever you want to name these bonds, use a specific feature that is applicable to a country. I'll repeat it. Use a specific feature that is applicable to a country. And to make it easier, general practices is we use a term which is associated with food. We generally use a term which is associated with food only. For example, I'll write certain examples now. You will have to tell me which of the country the currencies are denominated for these dollars. Let's start. Right? Samurai bonds. Please tell me, if you come across the term samurai bond, what will be the denomination? In what currency the bonds will be given value? Can I say Japanese yen? Anybody wants to argue against it? Japanese yen. Yen is a currency of Japan. So if you come across a samurai bond, these bonds are issued in yen terms and repaid in yen terms. What about dim sum bonds? What about dim sum bonds? Right, and those who are wondering what is this dim sum? Momos. Dim sum is nothing but momos. Can I say Chinese yuan? Can I say Chinese yuan? Right? And in case of India, masala bonds. Modern Indian history or even in a high school, can I say masala is associated with India? Correct? Masalas are nothing but associated with India. And I'll give you one more example, right? That is baklava bonds. Baklava bonds. Baklava bonds are also becoming very famous now. Baklava bonds are right, denominated in Turkish lira. Lira is the currency of Turkey. Lira is the currency of Turkey. Baklava bonds. Turkish lira. So all of you okay with this concept of masala bonds? Anybody has a problem? Let me know now. Right? Let me know. Anybody has a problem? Who will monitor these bonds? My dear, whoever is the regulatory authority in that country, they will regulate it. For example, please tell me, in case of India, is it okay if I say RBI? RBI is the regulator. Regulator in the sense, RBI will fix how much you're allowed to borrow. RBI will fix what should be the duration of the bonds, etc. In case of India, it is RBI. And please understand the next point as well. Is it just that the companies are allowed to borrow by issuing these bonds? Of course, no. Even international agencies, many of these bonds, including masala bonds, I'm saying, international agencies are allowed to issue this. For example, World Bank, right? Do you know World Bank will invest in India? World Bank will invest in other countries as well. So can World Bank to invest in India? I repeat, World Bank to invest in India, can they issue masala bonds in USA? Of course, yes, they can do that also. In fact, it has been done already by World Bank. So can we go forward? Can we go forward? So samurai is not a food or masala. Again, please understand, I used the term generally. Generally, the argument is use a feature that is associated with the country. Use a feature that is associated with the country. Either you can use a sport, you can use a delicacy, you can use food, you can use right, any other representation. Because there is no format here. There is no fixed format that you will have to follow this parameter. Absolutely no. Use anything that is representing a country, that represents a country, use that. Okay. Sir, but masala bonds can have a higher maturity, so it should be regulated by SEBI. My dear, no. External borrowing. External borrowing. You are borrowing from the external market, right? Because you're borrowing from the external market, the dollars or rupees, right, currencies are flowing in, it comes under regulation of RBI. Okay. Okay. Can we go forward now? Bonds are issued in the overseas market. These are issued and repaid in rupees. We'll call this as a rupee denominated bonds. RBI mandates that original maturity period is of 3 years for the investment up to $50 million or equivalent in rupees. And if it is more than $50 million or equivalent in rupees, then the maturity period has to be 5 years. So RBI has mandates. RBI has conditions regarding how much you're allowed to borrow, to what extent you're allowed to borrow. Okay. The exchange rate risk regarding masala bonds is always borne by the investor. For example, look at this. Let me know. Look at this. You are issuing this bond to me. You are issuing this bond to me, which means, let's say $1 is equal to 50 rupees today. Right? $1 is equal to 50 rupees. Can I say I will have to convert? I'm a USA investor. I will have to convert this into rupees and give it to you. Of course, yes. And in return, you will give me rupees. Upon maturity, you will give me rupees. Then I will have to convert that into dollars. So exchange rate risk will be borne by the investor, not by the issuer. Please remember that. Okay. Now, can we go forward? All of you okay with this? What do you mean by baklava? Baklava is a sweet. Baklava is a sweet, right? Very, very famous. Very, very famous. Baklava is nothing but a sweet. Okay. One question about reinvestment risk. We will discuss that later. Okay. So can we go forward? Can we go forward? Okay. Next concept I want to discuss will be the concept of IPO and FPO. IPO and FPO. Listen carefully now. We'll discuss what is the concept of shares, etc. Listen carefully. Point number one. Is it okay if I say shares represent ownership in a company? Anybody has a problem? Let me know. Shares are nothing but these are units. Units which represent ownership in a company. These are units, nothing but which represent ownership in a company. Meaning what? Let's assume a company has issued 100 shares and you have purchased 5 shares out of it, which means you are 5% owner in a company. Very simple logic. You're a 5% owner in a company. Right? That is point number one. Point number two, whenever you talk about shares, I'll come back to this. Just give me some time. Whenever you talk about shares, there are two types of shares. There are generally two types of shares. One is called as equity shares. Second one is preference shares. One is equity. Second one is preference shares. Now, what is the basic idea of equity as well as a preference share? Whenever you invest and purchase a share of a company, I repeat, whenever you invest and purchase share of a company and the company makes a profit, part of the profit is given to the investor in the form of a dividend. I'll repeat it. Part of the profits is given to the owners, that is to the shareholders, and that is called as dividends. Now, let's say there is one example where you will purchase a share and the company says, if I make profit annually, I'll give you fixed amount of dividend. I'll repeat the statement. Understand these concepts carefully. In one example, the company is issuing a share to you and the company says, if I make a profit annually, I will give you fixed amount of dividend. That is, let's say annually I'll give you 4 rupees per share. This year, if I make profit, 4 rupee. Next year, if I make profit, 4 rupee. Third year I make profit, I'll give you 4 rupee. So such types of shares where the returns, that is a dividend that is given, it is always fixed. Such types of shares are called as preference shares. Such types of shares are referred to as preference shares. And these are generally referred to as hybrid instruments. Why these are called as hybrid instruments? Please understand, preference share will carry certain features. It's basically a mix of features of a bond as well as a share. It will have features, a mixture of bond features plus share features. What do you mean by bond feature here? Please do let me know. Can I say, if you purchase this bond, annually a fixed returns is given to you? Let me know. If you purchase this bond annually, a fixed returns, that is a fixed amount of rupees is given to you annually. Anybody has a difficulty here? You purchase this bond today, after this year is over, you will get 6 rupee. After next year, you will get 6 rupee. After third year, you will get 6 rupee, right? So I hope you understand now. In case of preference share, these are owners of a company. Shareholders means these are owners of the company. And because these are owners of the company, it will carry certain features of the share. And second, because a fixed amount of dividend is given annually, it will also carry certain feature of a bond. Hence, these are called as hybrid instruments. Hybrid instruments carry a fixed dividend. Annually, the dividend that is given will be fixed. Are preferred over equity share whenever the dividend has to be distributed. That is, imagine a company has made profits. Part of the profits, when they want to distribute, the first preference is given to the preference shareholders. First preference is given to preference shareholders, and then equity shareholders are given, right, the dividend. Okay, that is one more important point. And finally, have a look at this. Whenever the decision of the company has to be done, whenever the company has to decide, these shareholders are not given any voting right. They will not carry any voting right. No voting right is given to these shareholders. These are the features associated with preference shares. Anybody has a difficulty? Anybody has got any kind of a doubt regarding preference shareholders? Can we go to the next? Equity shareholders. In case of equity shareholders, these are the owners, no doubt, these are owners, but please understand, these equity shareholders, there is no fixed dividend that is given. The amount of dividend that is given will keep on varying from 1 year to next year. The amount of dividend that is given will keep on varying from 1 year to next year. In 1 year, an equity shareholder can get 2 rupee dividend per share. Of course, I'm talking about per share. In another year, the equity shareholder can get 5 rupee dividend. In third year, they can get 1 rupee dividend, etc., etc. Right? So from 1 year to next year, how much dividend you are going to earn, there is no guarantee. It will keep on varying. And apart from this, because there is no guarantee, you are taking a higher risk. Generally, the equity shareholders are given the right to vote. Right? They have a vote to. They have a vote whenever there is a decision to be made. Whenever the discussion has to happen and decision has to be done in a company, they will have the right to vote. So there are two types of shares: equity shares as well as preference shares. Can we go forward now? Anybody has a difficulty regarding this? Anybody has a difficulty? Can we go forward? If you're reading newspapers very carefully, very recently in one of the annual general meetings, AGMs, in one of the annual general meetings, Mr. Kalyani was removed as a board, as a member of the board, because shareholders voted against his continuation. You can check it again. UPSC will not ask you who is Mr. Kalyani, what is the importance, etc., etc. Why it is called as a hybrid instruments? I'll repeat it again. Listen carefully, right? Why? Listen carefully. Please tell me, will you get fixed amount of returns on this bond or not? Right? Right. Those who are asking, answer it. Otherwise, I'll start taking names. Answer it. You will purchase this bond. Will get fixed amount of returns every year. How much? 6 rupees, 6 rupees, 6 rupees. Agreed. Now, if you purchase a preference share annually, I'll give you 4 rupee fixed. First year 4 rupee, second year 4 rupee, third year 4 rupee, fourth year 4 rupee. So can I say this is a feature of a preference share? It is present in a bond also. This feature of a preference share, it is a feature of a bond. Anybody has a problem? Second, you are a shareholder. It is called as a preference share. You are a shareholder, means you are a owner of a company. So it is not a, it is a feature of a share. So it has features of a share, it has features of bond, hence hybrid instrument. Hence this is called as a hybrid instrument. Okay, can we go forward? In preference share, annual interest plus fixed dividend. Who said that? Did I say you will get annual interest rate plus dividend? My dear, you are a shareholder. Where is the question of interest there? Listen carefully. You people are not listening carefully. That becomes a problem. You are a shareholder. Shareholder means owner. Do you think the owner will earn interest? Do you think you are giving loan to a company? No, there is no question of interest. A shareholder doesn't earn interest. Dividend is given to shareholder. Okay. Now, shares represent ownership in a company. By purchasing them, investor will get ownership of a company. These are tradable in the stock market. That is, please tell me, have you heard of Bombay Stock Exchange and National Stock Exchange? BSE and NSE. Newspaper readers, please do let me know. Have you heard of Bombay Stock Exchange as well as National Stock Exchange? You should have heard of it. Don't read. That's not important. Stock market has gone up. It has fallen down by so many points. It crosses 60,000 points. UPSC will not ask you that. But at least because it appears in newspaper every day without fail, you should have seen, okay, there is a stock market in India, Bombay Stock Exchange and National Stock Exchange. Right? So these are tradable in the stock market. You can buy them, you can sell them in the stock market. Okay. Shares are measured always in numbers. 5 shares, 10 shares, 20 lakh shares, etc. Why? There is one more term called as equity. Many of the students will get confused between a share and equity. Right? What is a share and what is equity? Share is individual units. These are individual units, whereas equity is percentage. They'll simply say shareholding. They'll simply say shareholding or equity or stock holding. What do you mean by that? Right? Is it okay if I give an example here? Listen to me very carefully. Imagine a company has issued 5 lakh shares. Imagine a company has issued 5 lakh shares. And out of 5 lakh shares, you will purchase, let's say, 20,000 shares. Now, I will simply say you are holding 4% equity in the company. You're holding 4% equity in the company. Right? So you might have purchased 20,000 shares. Those are individual units. But these individual units represent how much out of total number of shares. That is called as equity or stock holding or a stake holding in a company. So you will be referred as a 4% equity owner in a company. Right? Shares, individual units. Equity represents percentage ownership. And just to make it easier, please do let me know. Please do let me know. Have you come across the term equity in watching Shark Tank? How many of you seen Shark Tank? Again, is it compulsory? Absolutely no. I don't say, sir, I have not watched it. Will I fail UPSC? Will I not get through UPSC because of that? Absolutely no. Right? Don't worry, even if you have not seen. Have you heard of equity? Right? The investor, the shark investor will simply say, okay, I'll give you 20 lakh rupees. I will have 50% equity. I'll give you 10 lakh rupees. I will have 2% equity in the company. Right? Basically representing percentage ownership. Percentage ownership. Done? Can we go forward? Can we go forward? Now, there are two terms called as IPO and FPO. Right? IPO and FPO. Now, what is this concept of IPO and FPO? Point number one, IPO means initial public offering. IPO means initial public offering, and FPO means follow on public offering. FPO, follow on public offering. Now, what is this concept of an IPO? What is the concept of an FPO? Let's start. Today, I'll take an example. Listen carefully. Listen first. Today, let's say, right, some of you will decide, okay, economics is very difficult. I felt the same thing for polity also. Geography, I did not understand anything. Right? Ecology and environment, I did not attend classes. So what is the point in writing UPSC? I'll simply start a company. Again, just a joke. Do not take it seriously. You'll say, no point in studying now. I don't think so. I'll get through. I don't want to waste my time. I'll start a company. Now imagine you started a company. Imagine you started a company, and this company in let's say next couple of years will grow very well, starts earning lot of revenue. Now, please tell me, is it okay if I say as of now, you are the only owner of the company? All of you okay with the statement? As of now, let's say, right, next year and even after that, let's say till 2026, you are the only owner of the company. You have 100% ownership in the company. You have 100% ownership in the company. Now, imagine in 2026, you will decide the company requires a lot of money, right? There is a huge amount of investment that is required for the company. So what you will do? For the first time ever, I repeat, for the first time ever, you will sell the ownership of company to public. You will sell the ownership of the company to the public, right? That is to any investor in the market. Any investor in the market, you will sell your ownership. That is, let's say, you will take your company public, and whenever, please understand this, whenever the shares are sold for the first time to the public, that is called as initial public offering. Is it okay? Whenever the shares of the company for the first time ever is sold to the public means you can purchase the shares of this company. I can purchase the shares of this company. So whenever it is done for the first time ever, it is called as initial public offering, IPO. And whenever any company goes for an IPO, it simply means the company's shares are available in the stock market. The shares of this company are available in the stock market, right? You can buy them, you can sell them. Trading of the shares is allowed in the stock market. The company can get listed in the stock market, that is Bombay Stock Exchange or National Stock Exchange. The trading of the shares will start taking place. This is called as initial public offering. And whenever any company goes for an IPO, we'll call it as a listed company, a public company, or a listed company. I'll give you certain names. Let me know all of you okay with these names, right? The company Zomato, Paytm, right? Infosys, right? Adani company. All of you will agree. All these companies are listed companies. All these companies are listed companies. You can buy the shares, you can sell the shares of the company. Right? These are nothing but examples of the companies which have gone for IPO already. Now, let's say in 2026, the company has gone public. You have issued the shares in the market. Now the shares are traded. Now, again in 2035, Again in 2035, again the same company which is already listed can issue shares. Remember this, same company which has already done an IPO is allowed to issue shares again. In 2050, if they want to issue one more round of shares, they are allowed to issue. In 2070, if the same company wants to issue more shares in the market, they are allowed to issue. So whenever the company that is listed company, a listed company will issue shares again in the market, it is called as follow-on public offering. It is called as follow-on public offering. I'll give you a current affairs example, right? Just for sake of understanding. All of you heard of Adani company? Let me know. All of you heard of Adani company very, very recently in the last 1 year? Adani company last year wanted to do FPO. The company Adani wanted to do FPO, follow-on public offering. They wanted to conduct FPO last year. So one is IPO, second one is FPO, right? IPO is for the first time when the company will issue shares, it is called as an IPO. Second one, FPO, the company which has already conducted IPO will again issue shares, which is called as an FPO. They can do it second time, third time, fourth time as per the requirement, right? So one is IPO and second one is FPO. Now understand second set of terms, primary and secondary market, right? Remember this very carefully. We have discussed this earlier also. Primary market is a market where new issuance will take place. New issuance of the instruments will take place. That's called as primary market. Instruments are issued for the first time. That is called as a primary market. And the market where existing instruments, I repeat, the market where existing instruments are traded, it is called as secondary market. Best example of a secondary market in India for shares is Bombay Stock Exchange and National Stock Exchange. Understand this? Right? The issued instruments, already existing instruments are traded. That is basically a concept of the secondary market. And in case of India, Bombay Stock Exchange, National Stock Exchange is example of a secondary market for shares. Secondary market for shares. Can we go forward? Anybody has a problem? Can we go forward? Company, let's say, will conduct IPO. If company will conduct IPO, let's say you will purchase them, right? Or let's say I will purchase them, right? A bank will purchase them. Foreign investors will purchase them. There are different types of investors. So when I purchase these instruments directly from the company, when the company is issuing an IPO, I will purchase from from company directly. It is primary market. Now I am having shares of company. I will sell them to anybody else in the market. That will happen in the secondary market. Okay, so primary market and secondary market. Can we go forward? Anybody has any confusion regarding equity, right? What is difference between a preference share, equity shares? Any problem with the primary market, a secondary market, IPO, FPO? Please do let me know right now. Otherwise, I'll go forward. Anybody has got any kind of confusion? Sir, the 5 lakh shares are overall company shares. As you are saying 4% share, my dear. Imagine a company has issued totally 5 lakh shares and you purchased 20,000 out of 5 lakh shares. And that's the reason I said you'll have 4% ownership in the company. Any difficulty? What is primary market and secondary market? The new issuance market, the market where new issues are done, is called as primary market. For example, please do let me know, a company going for an IPO, can I call it as shares which were not issued now are being issued by the company? Let me know. Shares which are not being issued until now, these are not there in the public, are being issued now. Can I call this as a new issuance? So whenever new issuance of the instruments are done, these are not there in the system, these are issued now, it is always called as a primary market. And once the issuance is done, imagine you will purchase the shares, now you will sell them to me. Are you the issuer? Are you issuing them? No, you are simply investor. You have purchased them. Now you are selling it to me. That will happen in the secondary market. So existing instruments, do you understand the term new issuance and existing? So whenever existing instruments are traded, it is called as secondary. Whenever new issuance will happen, it is called as primary. Okay. Can BSE, NSE be included in primary market? Again, listen to me, no? Listen to me. You people are not listening to me. What is the issue? I don't know. In the Bombay Stock Exchange, one investor will sell the instrument to another investor. Is the logic okay? In Bombay Stock Exchange or National Stock Exchange, one investor who is holding the shares will sell it to another investor. Right? How can you call this as a primary market then? How can you call this as a primary? It is secondary market. Existing instruments are traded. Okay. So primary market and secondary market, the company issues the shares to the public for the first time. This is called as going public, initial public offering, and then right there is a follow-on public offering. Once IPO is done, the shares of these companies will be available for trading purposes in the stock market. And now we'll simply say the company is actually listed. Secondary market, the shares which have been issued in the primary market are traded in the secondary market. We have Bombay Stock Exchange as well as National Stock Exchange. In fact, those are asking why there are only two. There are not just two. There are many other stock markets in India. Most of the states have their own stock markets in India. But at the national level, the two biggest stock markets are BSE as well as NSE. Because understand the logic behind it. Imagine you're a very small company, you're present in only, right, let's say certain districts in a state. Right? If you go to the national market, if you go to Bombay Stock Exchange, if you go to the, let's say, National Stock Exchange, nobody will recognize you there. There will be nobody who will recognize you, and nobody is going to invest in your company. Nobody is going to trade your shares there. That is the reason even we have regional stock exchanges. We have even regional stock exchanges as well. Okay, so there are not just two stock exchanges, there are multiple, but at the national level, two are important, NSE as well as BSE. Okay, so idea for primary and secondary market, and IPO, FPO, equity market, etc. Now, all of you, okay, can we go forward? Right, if you remember, we have used the term the preference shares as well as equity shares earlier. We did not discuss it. I'll tell you the context also. The context was we discussed cooperative banking in India. Correct? We discussed cooperative banking in India. Last chapter, banking sector, right? Previous to that. In cooperative banking, the Banking Regulation Amendment Act of 2020, Banking Regulation Amendment Act of 2020 basically allows these cooperative banks to issue bonds, to issue preference shares, to issue equity shares in the market now. That was the amendment that has been done. Please be very careful. Okay. Okay. Let's go forward now. External commercial borrowings. External commercial borrowings, ECB, external commercial borrowings. Okay. Now, what is this idea for external commercial borrowing? Earlier we have seen, let's have a detailed discussion now. ECB refers to the debt that is taken by the domestic companies from external market. The debt that is taken by the domestic companies, that is the companies in India, will borrow from outside India, will make overseas borrowings. That borrowing is called as external commercial borrowing, ECB. Now, understand the logic behind this. They can borrow by using many instruments. They can use multiple instruments to borrow from an external market. The best example is these companies can issue bond outside India, borrow from outside India. They can go to a foreign market, take a loan from a foreign bank and borrow from outside India. So there can be multiple ways through which these companies in India can borrow from external market. All of those collectively are referred to as external commercial borrowings. Now, what is the advantage? Why is this promoted in India? Right? Is there any benefit associated with the concept of an ECB? Let's try and understand. Point number one, imagine you are a company. In India, you will take a loan, rate of interest is 7%. you will take a loan in USA, rate of interest is 2%. Please tell me, only based on this, right? Is it okay if I say you would prefer to borrow in external market rather than borrowing in domestic market? I'll repeat it. You're a company in India, you're an owner of a company in India. In India, you take a loan to import a machinery, rate of interest is 7%. Same amount you will take loan in USA, rate of interest is let's say 2%, 3%, 4%. Whatever the number is, it is less than 7%. So can I simply say it will provide benefit to you if you borrow from an external market rather than borrowing from the domestic market? So answer is yes. So interest rate, because it is lower in the external market, it will provide benefit to borrowers. That is the first one. Second one, have a look at this. Apart from the domestic market, now there is a foreign market also from where we can borrow. So it will increase the availability of capital. It will simply increase the availability of capital for the companies. So availability of capital will increase. They might end up borrowing at a lower rate of interest. That is also going to benefit. And third one, rather than converting your rupees into dollars, can you directly can you borrow dollars and use it to import machinery into India? Because some of you might simply say, sir, right, what is the issue? Let me convert rupees into dollars. My dear, don't you think if you sell your rupees, purchase dollars, you'll have to pay certain charges for it? Transaction cost. I'll repeat the statement. You want to convert your rupees into dollars so that you will use the dollars to import a machinery from USA. And don't you think you'll have to pay certain charges, transaction cost for converting rupees to dollars? So that is basically the argument. Rather than incurring all this cost, you'll borrow in dollars, import the machinery and repay the dollars in the future. So all these are the advantages. All these are the advantages associated with the concept of external commercial borrowing. Having said so, are there any concerns associated with this model? Are there any problems with this kind of a borrowings? Of course, yes. Point number one, have a look at this. If there is a volatility in the exchange rate, if there is a very high fluctuations in the exchange rate, the borrower under ECB will suffer. The borrower under ECB will end up suffering. That is, let's say hypothetically you borrowed when $1 was equal to 50 rupees and you want to repay when $1 is equal to 80 rupees. Such kind of volatility in the exchange rate, don't you think it will affect the borrower now? Right? The impact on the borrower could be very, very high. That is one concern. Second concern is, if you keep on borrowing from the external market, the amount of debt that whole of India owes, I repeat, amount of debt means repayment. The amount of debt that whole of India owes to the external market will keep on increasing. Is it okay? I'll repeat the statement. If you keep on borrowing more and more from the external market, the amount of debt that whole of India owes to the rest of the world will keep on increasing. Very high amount of a debt is not good. High amount of a debt is not good, especially in terms of foreign currencies, especially in the form of foreign currencies, right? That is one more concern. In fact, I'll extrapolate. I'll elaborate this discussion of the second point. Understand this carefully. If you borrow in rupees, you can repay in rupees. Can I say rupee is a domestic currency? If we want, that is government of India as well as RBI feels that rupee supply should be increased, can we print rupees, increase the supply? Of course, yes, concern is that inflation might happen, etc., etc. But do we have the right power to print more rupees? Of course, yes. But if you borrow in terms of dollars, you do not print dollars in India. Now you'll have to pay more and more in terms of dollars. Can I simply say dollar outflow from India will start increasing because of higher debt? Think of it. Today you might borrow, but after 5 years, if repayment will come, you will have to pay a lot of dollars, which means a dollar outflow from India might start increasing. It will put a lot of pressure on the exchange rate. It will put a lot of pressure on the forex reserves held in India, etc. Right? So volatility in the exchange rate is a concern. if it is available at a cheaper rate, loans are available at cheaper rate, don't you think the companies might waste some of the resources? They may not utilize the resources very efficiently because it is available at a very cheaper rate of interest. They might become complacent. They might become more relaxed. That is also cause of concern. It will increase the dependency on foreign funds. Debt of India will increase. Very high borrowings in a form of debt for any company is always a cause of concern. Because please understand this, a company can raise money by borrowing and by issuing shares. You can do either of them. Okay. You can borrow, you can issue shares and get the money. But if you keep on borrowing continuously, if your debt keeps on increasing continuously, don't you think there's a pressure of repayment? That is, you will have to pay interest on your debt. On the other side, if you take the money from the investors, that is shareholders, they are owners. Shareholders are owners. Of course, you'll have to pay dividend. But please tell me, is there, let's say equity shareholders are there, is there a pressure on the company to provide a fixed amount of returns to the equity shareholders? No. Right? So you can raise money through equity also. You can raise money by borrowing also, but borrowing means repayment. Repayment pressure is always higher. Right? That is also a cause of concern. Right? So these are some of the advantages as well as disadvantages associated with external commercial borrowing. All the entities which are eligible to receive foreign investment, there's a technical term FDI, we'll discuss that later. Please do not panic. Right? Next week we will discuss a chapter by the name of the investment models. And in the investment models, we'll understand what is FDI, what is FPI, etc., etc. Right now, do not panic. Any company can attract foreign investments in the form of FDI, can go to the foreign market and raise borrowings or raise loans in the form of external commercial borrowings. And how much is the limit? How much is the limit? Until last year, the limit of borrowing was $750 million. Now this has been increased to $1.5 billion. Please remember this. Until last year, the borrowing limit under the ECB route was limited to $750 million. Last year, this has been increased to $1.5 billion. Reason is very simple. Last year, there was a concern that the forex reserves, the dollar availability in India is actually going down. The forex reserves started coming down. The dollar availability in Indian market started going down. To increase inflow of dollars, I repeat, to increase the inflow of dollars, RBI doubled the ECB limit from 750 million to $1.5 billion. Right? So these are certain very important points regarding the concept of external commercial borrowing. Right? Why it is done? Right? Who is allowed to do it? Right? For what purpose it is being utilized, etc. And what is the advantage? What is the disadvantage? Can we go forward now? Anybody has a problem with this? Can we go forward? Please do let me know. Sir, but the percentage of ECB is very low. If any private entity failed to operate in ECB, who will take liability of paying? What do you mean by if any entity fail to operate in ECB? I do not understand the question. Please do let me know. When you say if any private entity fail to operate in ECB, I do not understand. Please clarify it. Okay. Anyways, let me go forward. Concept of P notes. Concept of P notes. P notes are referred to as participatory notes. Right? P notes are nothing but participatory notes. Participatory notes. Now, what is this concept of a participatory note? Let me explain. Listen to me very carefully. Slightly technical. Please listen carefully. Imagine you're a foreign investor. Okay, imagine you're a foreign investor. And when I say foreign investor, always remember this. Foreign individuals are allowed to invest in India. Foreign institutions are allowed to invest in India. For example, can you invest in the USA stock market? I'll repeat this question. Are you allowed to invest in the USA stock market? Answer is yes. Answer is simply yes. You are allowed to invest in the USA stock market. So for USA, can I call you as a foreign investor? Is the logic okay? For USA, you're a foreign investor. In the same way, even in Indian stock market, foreign investors are allowed to invest. But the condition is that whenever they want to invest in India, they will have to take approvals, licenses from SEBI. They will have to take approvals or licenses from SEBI, Securities Exchange Board of India. First, they will have to take a license, right? Submit lot of documentation, take approval, and then invest in India's market. And that is a condition. Now, let's say here is a foreign investor X. Okay, here is a foreign investor X. X wants to invest in India's stock market, but for whatever reason, X doesn't want to go through SEBI. Right? X feels documentation is very lengthy, or X feels SEBI is asking a lot of questions. I do not want to reveal all the information to SEBI. Or X feels, right, I don't have all these documents to submit to SEBI. For whatever reason, X does not want to go through SEBI route. SEBI route means go to SEBI, get the approval, and then invest in India stock market. X doesn't want to do it. So what is the option available? Can X invest in India without approval, without going through the SEBI? Of course, yes. There is a route called as participatory note. Participatory note. Now, what is this concept of a participatory note? What is this idea of a participatory note? In case of participatory note, generally the concept is the foreign investor will give the money. I've given it in the picture here. Please have a look at this. Will give the money, that is investment, to a foreign institutional investor. This foreign institution means company, right? Mutual fund companies, insurance companies, these are called as institutions. So this foreign institutional investor is already registered with SEBI. This FII is already registered with SEBI. So X will give the investment to this FII, and this FII in return will issue an instrument to the investor called as participatory note. Process is very simple. Do not complicate it. Process is very simple. Imagine you are the foreign investor. I am the FII. I will take the money from you. I will take money from you and I will issue this instrument. I will give you this instrument. This instrument now which is there with you, it is called as participatory note. It is called as participatory note. Now what will I do with this money? I will take this money, let's say 100 rupees. I will invest and purchase share of, let's say, Adani company. Simple example, by the way. Okay, I will take this money and I will invest in the shares of Adani company. So now let me know, can I call this process, can I define it in this way? Can I define it like this? A foreign investor without any approval from SEBI is investing in India through participatory note. I'll repeat the statement. A foreign investor, in this example, a foreign investor without taking the approval of Securities Exchange Board of India is investing in India, is investing in India's market through participatory note. Anybody has a difficulty in understanding the process, understanding what is this participatory note? Please do let me know. Now, point number two. Point number two, can I call participatory note as offshore instrument? Let me know. Can I call participatory note as offshore instrument, right? Or overseas instrument? That is, these are issued outside India, not within India. These are issued outside India, overseas instrument. Point number three, there is a term called as a derivative. Very technical. You don't need to understand the derivative market, right? In the market, financial market, there is a segment called as derivative market. Very technical market, very technical market, but understand the concept here. Concept is more than sufficient. What do you mean by derivative? Derivative simply means it is an instrument which will derive its value from an underlying asset. I'll repeat the statement, then I'll give you example. Derivative is an instrument which will derive its value. It doesn't have any independent value. It will derive its value from an underlying asset. Now, what do you mean by derivative? Is there any example? Let's start. Imagine, right? Imagine this example. I will, right, collect your 100 rupee and I will issue this participatory note. I'll repeat it. I'll collect your 100 rupee in the same example. I will collect 100 rupee and I'll give you this particular participatory note. And I will use this 100 rupee to purchase shares of Adani company. I'll use that 100 rupee which I've collected from you to purchase the shares of Adani company. Now, please tell me, can I say, as the market price of Adani share will keep on changing, your instrument value will also keep on changing? All of you okay? I'll repeat the statement here. You are holding this instrument, participatory note. You're holding this instrument which says that you have given me 100 rupees to invest in India stock market. So I've taken this 100 rupee and I've given this particular participatory note to you. I have invested this 100 rupee and purchased a share of Adani company. Now, please do let me know. Point number one, please do let me know. Is the market price of Adani company share, is it always constant or will keep on changing? Question number one. Is the market price of Adani's company share, is it constant or will keep on changing from day to day basis? It keeps on changing. All of you will agree. In one day it will be higher, in another day it will be lower. It is fluctuating. So when I purchased, I'm FII, when I purchased, the market price was 100. Tomorrow it becomes 106. So now can I simply say the participatory note is deriving its value from the market price of Adani share. Is it okay? The participatory note is deriving its value. The value of participatory note will also keep on changing because it is deriving its value from Adani's market price of the share. If the market price goes down, the value of the participatory note will fall down. If the market price of Adani share will go up, right, the participatory note value will also go up. That's a basic idea of a derivative. In the market, there are different types of derivatives. Futures, options, swaps, etc. Now, you don't get into all of those. These are very, very technical in nature. Please do not get into all of it. Understand the basic idea, more than sufficient. Derivatives are those instruments which will derive their value from an underlying asset. There is an underlying asset. Derivative is an instrument. It doesn't have any independent value. It will simply derive its value from an underlying asset. And that is the reason, look at the name. I think that should be very clear now. That's the reason, look at the name. The name itself is called as derivative. The name itself is referred to as a derivative instrument. Okay? Right, so P notes, now let me know. Can I say P notes are offshore derivative instruments? Let me know. P notes are nothing but offshore derivative instruments. Okay, so point number one, these are offshore derivative instrument. Point number two, these are financial instruments used by the foreign investors to invest in India's security market. And the beauty of P notes is that you do not have to be registered with the SEBI. You can use an institution which is already registered with SEBI. Okay, and that is basically the concept of P note. Now, generally, before I go forward, generally the concern which has been raised by various experts is that P notes route can be misused. There is a potential misuse of P note route. Right? That is a lot of black money which is present in India can be routed back into India through the concept of P note itself. How? Let me give a very simple example. Imagine I have got a lot of black money. I will launder this money, take it to USA. Right? You have heard of term black money laundering? Yes or no? Have you heard of the term black money laundering? Laundering means cleaning. Launder is nothing but cleaning. And whenever you come across the term money laundering, it simply means you are converting black money into white money. You are converting black money into white money. That is called as money laundering. I want to launder this money. So what I'll do? I will, through various right unethical means or illegal means, I will get this money transferred to USA. Right? I'll get this money transferred to USA. Now you are my friend sitting in USA. I will give this money to you. Through you, I will make these investments in India through participatory notes. Think of it. Through you, I will use you as a tool to route the investments back into India through participatory notes. Possible? Can it be done? Of course, yes, it can be done. And it can be done even for rigging of the prices, right? Price rigging. There is a term called as price rigging of the shares. What is this price rigging of the shares? Understand this carefully. Imagine right now, market price per share. I'm owner of a company. Market price per share is 20 rupees per unit. 20 rupees per unit. And we are holding negotiations. You want to purchase the ownership of my company. So can I use this route to rig the price, to increase the market price of the share? Possible. Understand how. Again, I'll use this, right, the P note route to route some of my investments, back into shares of my own company. I'll repeat the statement. Right? I will route my investments through P notes back into Indian stock market into shares of my own company. Now, please tell me, if the shares of my own company, the demand for it, because of P notes, if the demand for it increases, will it not lead to increased market prices? All of you okay with this? Can this increase the market price of the share? Yes. Now imagine we were negotiating when the market price of the share was 20 rupee per unit. Now because of this, the market price of the share will increase to 30 rupees per unit. Don't you think I will demand more money now from you if you want to buy out my company? Yes? Possible or not? Right? Can I demand more money to buy out, right, from you if you want to buy out my company? Of course, yes, I can do it. But this is unethical. This is not allowed. Price rigging through this P note route is not allowed. In fact, this was discussed very recent in the context of Adani company. It was discussed in the context of Adani company, not basically sell out, but I'll tell you what was the allegation. You understand allegation, right? Whether it is true, false, etc. Supreme Court will take care of it. You don't worry about it. Now, please do let me know, can this route be used? Again, P note or direct purchases, otherwise, can this be used to increase the market prices of the share? Point number one. All of you okay with this? Either P note route or a foreign investor directly investing after let's say getting approval from SEBI. Can this route be used to increase the market price of the share? Of course, yes, it can be used. Point number two, please understand the second point. The owners of company are generally allowed to borrow from a bank. They're allowed to borrow from a bank. But when they borrow from a bank, they will have to provide collateral. What they do is they will provide those shares. They will provide the shares as a collateral. They will provide the shares of a company that they have as a collateral, and they are allowed to borrow. Point number three, please do let me know. Very basic idea. Let's take a very simple number. Imagine 70% of the market price of the share. 70% of market price of the share. That is where, right, the bank can give you loan. If the market price of the share is 100 rupee, bank will collect it. They'll give 70 rupee as a loan. If the market price of the share is 500 rupee, they will collect it as a collateral. They'll give you 350 rupee as a loan. Now, please do let me know, if through these methods, if the prices of the shares are rigged, if there is a price rigging of the shares, by providing the same number of shares, can I borrow more money from a bank? Yes or no? I'll repeat it again. If through these methods, through P notes or through direct purchases, etc., if prices of the shares are rigged means fixed. If the prices of the shares are rigged, now can a owner of a company pledge same number of shares and borrow more money from a bank? Possible or not possible? Arey Baba, participate. Most of you are worried about break only. I'll give you break, don't worry. But you tell me, All of these were there in the newspaper, by the way. Those are asking me, right, how it is possible, etc., etc. Is it possible or not? Of course, yes. Imagine right now market price of the share is 100 rupee, which means by pledging a share, 70% of it, I can borrow 70 rupees from a bank. I can borrow 70 rupees from a bank. But through, right, other routes, that is P note route or direct purchases from my own company, which is there outside India, demand for these shares will increase. And demand for the shares increases, what should happen to market price? Market price should also increase. From 100 rupees, now the market price per share will become 120 rupee. 70% of it means I will pledge a share now. Instead of 70 rupees, I can borrow 84 rupees from a bank. All of you are able to understand at least now? Let me know. All of you are able to understand at least now how price rigging can be done in order, right, to borrow more, right, to basically get more bank loans. This is one of the allegations. This is one of the allegations. Please be very, very careful. Please be very, very careful. Okay. Now there is one more current affairs topic here. Current affairs. There's a term called as short selling. There is a term called as short selling. Listen very carefully. You will not get this in the books, but because of the Hindenburg versus, let's say, or Hindenburg and Adani company, the term short selling has become very famous now. What is this concept of short selling? Listen carefully. First, listen. Imagine you have an instrument. I will borrow the instrument. Is it okay? I will borrow the instrument. Means what? Imagine you have one share of a company. I will borrow the share for 7 days. I will simply borrow the share for 7 days. And because I've borrowed share, I will again give back the share only. All of you okay with this? Because I've taken the share, I will return the share to you. But what is the logic? Listen very carefully. Today, I will take this share from you. Okay, today I'll take this share from you. Imagine the price of the share is 100 rupee. I will sell it. Today, I will borrow the share from you. Market price of the share is 100 rupee. I will sell it. So how much money I earned? I earned 100 rupee. And after, let's say, 4 days, after 5 days, when the market price of the share will fall down to, let's say, 60 rupees, when the market price of the share will fall down to 60 rupees, using this 100 rupee, I will purchase one share. I will earn profit of 40 rupees. I will purchase one share and return it back to you. This is called as short selling. Everybody is okay with this? I'll repeat it. Listen to me very carefully. This was there in the current affairs. Short selling is a practice wherein instruments are borrowed, sold, later purchased at lower price and returned. Right? Is it okay? I'll repeat it. Short selling is a process wherein instruments are borrowed, not purchased, borrowed, sold, and later when the market price will fall down, purchased and returned. Right? This is basically concept of short selling. That is sell high, buy low. Sell high, buy low. That is a concept of short selling. This is basically the idea of short selling. Very, very famous. Please be very careful. Right? Very, very famous in India today. And it has become very famous because of Hindenburg. Adani versus Hindenburg. Right? So basically, I will borrow instrument from you. I'll borrow the instrument and I will sell it today. And later when the market price will fall down, I will purchase and hand it, right, return the instrument to you. This is called as short selling. This is called as short selling. And many of you will simply say, sir, you're assuming market price will fall down to 60 rupees. What if it will go up to 120 rupees? Then I'll incur losses. It's very simple. I will incur losses. If I purchase it at 100, my expectation, it will fall down below 100. My expectation is that it will fall down below 100. But if it goes above 100, it is a loss for me. It's very simple logic. And may I be asking, what is my benefit in that if I give you instrument? My dear, I'm expecting price will fall. You will pray that price should increase. Very simple. It's very simple. My prayer is that price should fall down. Only then I will make profits. You will pray that price should go up. So that when you gave the instrument, it was 100 rupee. If it goes up to 120 rupees, if I give you this instrument back, whose value is 120, you will sell it in the market, you will make profit. That's a basic idea. That's a basic idea. So understand this. Those investors who will earn when the prices will fall down, these are called as bears in the market. Those investors who will earn when the prices will drop, these are called as bears in the market. And there are other investors who will earn when the prices will go up. These are referred as bulls in the market. Is it okay? One is bear. Bear means market going down and they will earn. And the other one is bulls. The market will go up, they will earn. And some of you will ask, sir, how bulls will earn? Very simple. Imagine this is a share, not a bond, share. So forget about 6%, forget about 3 years. I will purchase the share at 100 rupee. When the market price will become 120, I will sell the share. So buy low, sell high. I hope you understand. I hope you understand. In bull market, what generally happens? Please understand this. In a normal circumstance, normal in the market, what is expected? You will buy low. You will buy low and then sell high. And then sell high. That is, you buy it when the prices are lower and you sell it when the prices are higher. That is normally what happens in a market. But in short selling, exactly opposite. You will sell when it is high and you will buy when it is low. You will sell when it is high and buy when it is low. Sequence is important. Sequence is important. Don't say, sir, buy low, sell high. Here also there is buy low and sell high. No, sequence is important. First, you will buy when the price is low. You will sell it when the price is high. You will earn profit. You will borrow, not purchase. You will borrow and sell when the price is high, and you will purchase when the price is low and return. That is short selling. That is basically the concept of short selling. It was there very recent in the newspapers. Please be very, very careful. And some of you will understand, sir, if I know that prices are going to fall, etc., why will I give it to you? I will not give it to you. My dear, it is a market. It's a market. According to my calculations, prices will fall. According to your calculation, prices will rise. So from one investor to another investor, analysis is different. I am betting that price will fall. You are betting that prices will rise. So from one investor to another investor, analysis is different. So don't you think there are two parties in short selling who are willing to lend and borrow instruments because of this? Think of it. There are two parties in the market. One is a lender and the other one is borrower of instruments because their analysis are different. One investor feels prices will increase. So if somebody approaches and says, I want to borrow instruments for short selling, they'll say, okay, use it. And there is another investor who feels prices will fall down now. Right? So, and they know that market prices are higher, so I will borrow. And some of you might be thinking, why does Hindenburg do it? Why is Hindenburg doing it? Please do let me know. Just follow the sequence here. Just follow the dots. Hindenburg has prepared a report which says, right, Adani company is doing A, B, C, D, and none of them is positive. All of them are negative. I'll repeat the statement. Right? Imagine I'm a Hindenburg. I've prepared a report, not yet made public. I've prepared a report which says Adani company is rigging their prices. Adani companies are routing their investment back into India, which is not allowed, etc. The report is ready. So now tell me, logically, what does your common sense say? Once the report is made public, will the market price of the Adani's share, will they increase or decrease? Let me know. What does your mind say? What does the common sense say? Once the report is published, what will happen to market price of the shares? Don't you think automatically the price of the shares will crash? Correct. Automatically the price of the shares will crash. So now before I publish, can I go for short selling? Think of it. Before I am publishing this report, can I go for short selling? That is, I will borrow your instruments of Adani company. I will borrow and I will sell them at, let's say, 100 rupees. Now I'll publish report that will drag down the market prices to 30 rupees, 40 rupees. I have sold, I've earned 100. I will use that money to purchase the shares at 40 rupees. Will I not make profits? Will I not earn profits? Of course, yes. I'll make huge amount of profit and I'll return the payment. I'm sorry, I'll return the shares to you. That is how short selling actually works. It is risky. Of course, yes, it is risky. Hindenburg does it because they know they have prepared a report. They know that once the report is published, they know that the market prices will crash. That is the reason with so much of confidence they will enter into short selling. Okay, done. So let me go forward to the concept of credit trading. But before that, let me take a break. If anybody has a question regarding what we have discussed so far, please do let me know. Otherwise, we can take a break. And before I go forward, I know a lot of current affairs I'm discussing. This chapter is full of current affairs. So please be very, very careful. Please be very, very careful. A lot of current affairs concepts are there. You might not find these in the books, but definitely yes, these are important. Okay. Any questions? Any questions? Let me know any questions. Otherwise, I'll take a break. So is the process of launching IPO is important? No, process is not important. Process is not important. Again, the process is given in multiple sources. My recommendation, don't read it. Not important. Again, in last year, I discussed the process. In last year batches, I discussed the process because at that point of time, 22, right, there are a lot of IPOs which are being discussed in the newspaper. That's the only reason. Regarding short selling, is it shares only or any instrument? It can be done for any instrument, but please understand, mainly done using shares. Can you tell relation between P notes and derivative market? Again, I'm not saying derivative market is consisted of P notes. I'm saying it is a concept of derivative. Concept of derivative. What do you mean by derivative? Derivative means any instrument which will derive its value from something else. So in case of P note, whatever investments have been done, let's say in the stock market, the value of those shares will determine the value of P note. Hence, I said P note will derive its value from these shares. Hence, it's a derivative. Okay. In this question, have the questions come in the prelims or mains? Sometimes most of the questions have come in the prelims. Mains in the last 2 to 3 years, no question has come from this chapter. Okay. If inflation is 10% and interest is 6, it is useful if the total coupon rate is 16 and not 6 point in case of inflation. Again, how inflation adjustment is done, they will tell you. If it is 10%, they might say, I will increase the coupon rate by 10%, that is plus 10%, or I'll simply adjust it by 10%, that is 6.6%. The issuer will tell you, the issuer will give you a clear information how the inflation adjustment will be done. If any private entity is registered with India, it failed to pay ECB, then who will take liability? Indian ERC? Generally, it is done in the foreign markets. From where you have borrowed, from which market you have borrowed, they will drag you to that particular country's judiciary generally. Okay, done. Do we need to remember all the countries' currency? No, you don't need to remember all the countries' currencies. Okay, let me take a break now. Let me take a break. Time is 8:03. I'll restart the discussion at 8:18. I'll restart the discussion at 8:18. Take a break. Okay, welcome back. Just a second. Okay, welcome back. Good morning, everyone. Am I audible? Can we start again? Hope I'm audible. Let's start. Okay, next concept I want to discuss is the idea of a credit rating. Concept of credit rating. Very recently, the concept of sovereign credit rating was there in the newspaper. Understand this very carefully. What do you mean by credit rating? It refers to the ability or the willingness of a borrower, that could be a company or could be a government, to repay the debt. Very simple. What do you mean by credit rating? It represents ability of the borrower, the willingness of a borrower to repay a loan, to repay a debt. That is called as a credit rating. Now, credit rating is given for companies, credit rating is given for government also. Just like individuals, such as you and me, we have CIBIL scores. Individuals, we have CIBIL score. Companies, governments will have credit ratings. Generally, in the international market, there are three very important credit rating agencies. I'll start using the short form CRA, credit rating agencies. In the international market, there are three very important credit rating agencies. By heart the names now. One is Moody's, second one is Fitch, third one is S&P. S&P stands for Standard and Poor. S&P, Fitch, and Moody's. These are the three very important global international credit rating agency. More than 90% of the total credit rating market is controlled by these three rating agencies themselves. In India, we also have some of the domestic credit rating agencies. The names I've given some of them here. ICRA, right? There is CRISIL also, etc. So in the domestic market, we have credit rating agencies, but the global ones are the most important one. By heart those. Now, whenever the credit rating is given for the government, I repeat, whenever the credit rating is given for the government, it is called as sovereign credit rating. It is called as sovereign credit rating, sovereign CR. And for the companies, generally we'll call it as a credit rating. Next point. Whenever you say credit rating, either it is represented in the form of only alphabets or it is a combination of alphabets and numbers. It is represented either only in the form of alphabets or combination of alphabets plus numbers. For example, in case of Standard and Poor and Fitch, in case of Standard and Poor and Fitch, you will see only alphabets: triple A, double A, triple B, C, D, etc. Whereas in the context of Moody's, it's a combination of alphabets as well as numbers, right? Double A2, triple A2, I'm sorry, triple A, A2, A3, A1, BA1, BA2, etc. It's a combination of numbers as well as alphabets. Next point. Whenever credit ratings are given, these are divided into two parts. Credit ratings, the whole table can be divided into two parts. The one part, that is, please do let me know all of you are able to see credit ratings within red box here. One is credit ratings within red box, and the second one, credit ratings within blue box. Credit ratings within blue box. What is the basic idea? Any rating that is there in the red box, any rating that is there in the red box, this is called as investment grade. These ratings are called as investment grade. Right? For example, triple B is an investment grade. Triple A is an investment grade. Double A is an investment grade. BAA2 is an investment grade. So anything that falls in the red box is called as investment grade, and anything that falls in the blue box, this is called as a junk grade. This is called as junk grade. And what is the basic difference here? The junk grade credit ratings are very low, risk is very high. Any instrument that will carry a junk grade, ratings is very low, risk is very high. any investment that has got a investment grade, it is meaning that safety is higher, risk is there, safety is higher and risk is low. Right? That is a basic idea of an investment grade and a junk grade. And in the context of India, this is where I want you to connect to current affairs. In the context of India, India's sovereign credit rating is the lowest investment grade. It is BA3 in fact here. India's sovereign credit rating is the lowest in the investment grade. Lowest in the investment grade. And please understand, many of you ask me now, sir, how do they calculate it, right? What parameters are taken? It's a very, very complicated process. Point number one, from one rating agency to another rating agency, there is no fixed methodology. Is it okay? From one rating agency to another rating agency, there is no fixed methodology. It will vary from one agency to another agency. Point number two, and even if they are following a methodology, there is no clarity regarding what parameters are given how much weightage. Which parameter is given how much weightage? There is absolutely no clarity regarding this. There is a complete opaqueness. In fact, I'm quoting the report that was published very recently by CA, Chief Economic Advisor. I hope you have come across those articles in the newspaper. There is one essay that has been written by Chief Economic Advisor's office, which says there is opaqueness regarding. There is opaqueness. Opaqueness means there is no clarity. There is opaqueness as to what parameter is considered, how much weightages are given, what is the methodology from one rating agency to another rating agency. There is a opaqueness, and this has been one concern which has been raised by Government of India for the last couple of years. Why? Government of India says, if you look at the stability of economy in India, if you look at India's GDP, if you look at inflation in India, if you look at fiscal deficit of India, etc., all of them are at a very, very comfortable position to us. Nothing out of this is very, very high for us. For example, fiscal deficit, no doubt, it has been around 6%, but it is not 11%, it is not 20%, it is not 50% as is experienced by many other countries around the world. If you talk about the debt, India's debt is somewhere around 80%. Somewhere around 80%. No doubt during pandemic it went up, but now it is somewhere around 80%, whereas debt of many other countries is more than 100%. So Government of India has been criticizing the rating agencies and has been very vocal in saying that they do not follow any methodology which is transparent. These are not following any transparent methodology, and their methodology has a bias against developing countries. I'll repeat the statement. Government of India's contention is because there is no transparency methodology followed by these rating agencies, they are biased against developing countries. In fact, to prove that, the essay that was published by Chief Economic Advisor says that between 20 and 22, more than 50% of the African countries which were rated by the credit rating agencies, I repeat, more than 50% of the African countries which were rated by the credit rating agencies between these 2 years, there has been a downgrade. In African countries, more than 50% of the countries, they have downgraded. Whereas in the European market, they have downgraded only by around 9 or 8 countries. So which means there is a bias, inherent bias that these credit rating agencies have towards the developing countries. And there is one more argument. There is one more argument which Government of India says. Many of these rating agencies take some of the indicators which there is no measurement for these indicators. You cannot measure these indicators. For example, please tell me, if you are going to have a credit rating based on rule of law, please tell me, can I say this is a perception based indicator? Perception means it's a feeling. How do you feel about rule of law? How do you feel about governance measures, etc.? These are perception based indicators, and these perception based indicators are considered by rating agencies to provide credit rating for the countries. So I hope you understand, Government of India, not only this year, even in the last year, has raised voice against the concept of the methodology followed by these credit rating agencies, especially for sovereign credit rating. And one more concern which has been raised is between these developing countries, right, or amongst these developing countries, if there is any movement in the credit rating, if there is any movement in the sovereign credit rating, it will put a very big burden for borrowings of these the governments. Let me prove it to you. Let me prove it to you. Can I generally say developed countries such as USA, because these are developed countries, their sovereign credit rating will be much better? Yes or no? Please do participate and do let me know. The developed countries, because they are developed countries, don't you think their sovereign credit rating will always be better compared to a developing country such as India? India has a sovereign credit rating of triple B. It has a sovereign credit rating of Baa3. It has a sovereign credit rating of triple B. And if there is any downgrade, even if there is a small downgrade for India's sovereign credit rating, it will fall down to junk grade. It will simply jump into the junk grade. And now please tell me, if there is any downgrade of sovereign credit rating, whether within the investment or even in the junk grade, if there is any downgrading, don't you think it automatically means it is risky to provide loans to the government? Correct? It is now more risky with the downgrade. It is more risky to provide loans to the government. And during pandemic, government of India has borrowed heavily. And there was a concern raised by the rating agency saying that you're borrowing very heavily. This we might consider and downgrade you further. And if there is a further downgrading, it becomes more risky, which means government has to offer more rate of interest. It has to offer a higher rate of interest that will further increase borrowings of the government. So it's a cycle. It's a cycle. Developing countries need to borrow more, but if they borrow more, there might be a downgrade. If there's a downgrade, it becomes more risky to give loans, which means again government has to offer more interest, which will further increase the debt of the government. So that is the concern which has been raised by the developing countries such as India against these sovereign rating agencies or these credit rating agencies. Then all of you okay? But now what is the use of the credit rating? Many of you will have this kind of a doubt. Agreed, sir. There are concerns. Government of India has raised it, etc. Agreed. But what is the use of credit rating? Now imagine you want to invest in the market. You want to purchase certain instruments. Don't you think credit rating will help you in deciding which instrument is less risky, which instrument is more risky? Then first advantage for investors, it is a point of information. Looking at the credit rating itself, you can take a decision whether to invest or not to invest. Second, don't you think the companies which can have a very good credit rating, they'll be able to borrow from the market at a very low rate of interest? Correct? If a company has got a very good credit rating, triple A, double A, don't you think it can show you that particular very good credit rating, excellent credit rating, and borrow at lower rate of interest from you? Of course, yes. Right? So the market will get the benefit, the borrowers can get the benefit, the investors can get the benefit from the concept of credit rating. Anybody has a problem? Can we go forward now? Right? So for Fitch, S&P and Moody's, it is a Baa3, triple B, right? Baa3 or triple B, the lowest grade within the investment grade. Can we go forward? Anybody has a doubt regarding the concept of credit rating, sovereign credit rating? What is the use of it? What is the concern raised by the government? The same argument. Why USA has a more credit rating? Please understand, USA is a developed country. USA is a developed country. And because it's a developed country and it performs better in these kind of perception based indicators also, their credit rating is much superior compared to India's credit rating. And again, I'm saying, what parameters are there? How much weightage has been given? What kind of experts have been identified to collect data? There is no transparency at all. There is absolutely no transparency. And that is a grievance of government of India. That's a grievance of government of India, which I've already told you. Okay. Can individual persons be rated by credit rating agencies? My dear, individuals cannot be rated by credit rating agencies. Not these Moody's and Fitch, they will rate companies, they will rate instruments, they will rate governments. Individuals, it is CIBIL. Individuals, it is CIBIL always. Okay. Next, concept of mutual funds. Concept of mutual funds, right? What is this idea of a mutual fund? Look at the definition for it. A mutual fund is a type of investment vehicle constituting portfolio of stocks, bonds, or other securities. Point number one, portfolio. Point number one is portfolio. What do you mean by portfolio? Portfolio always means a group. It's a group or collection. Portfolio means a group or collection. Okay. Now let's start. What is a mutual fund? Right? Why it is called as a portfolio of securities? Let me explain. Please listen to me very carefully. Right? This is how mutual funds actually work. There is one company. This is called as a asset management company. Why it is called as asset management company? You will understand. Just give me 2 minutes. Let's say this is a Nippon Mutual Fund, or it is a ICICI Mutual Fund, or it is Franklin Templeton Mutual Fund, or SBI Mutual Fund Company. Now, all of you who want to invest in the stock market, please do let me know. Does everyone know how the stock market operates? Think of it. Right? Does everyone know how the stock market operates? When to buy, when to sell, which company to purchase, how much to purchase? No. Can I say the same thing regarding the bond market also? You may or may not have expertise in the bond market. So can I say there are various investors in the market who want to invest in the stock market, who want to invest in the bond market, but they don't know how to operate. They don't know how to invest. So there is one investment opportunity that is available. That is, there are experts who will collect their investments, invest in the stock market or invest in the bond market. But these experts, for having provided things, for having provided these services, will charge certain amount of money. Right? Such investment vehicle that is available for the investors, it is a mutual fund instrument. Mutual fund instrument. How that will happen? Let me take an example. Let me explain it. Imagine there are three investors, investor A, B, and C. These three investors will purchase instruments which are issued by the mutual fund company. I repeat, these investors will purchase instruments which are issued by the mutual fund company and will give money to the mutual fund company. These instruments which are issued by the mutual fund company are referred to as mutual fund units. So the white arrow lines are nothing but the mutual fund units, and the black arrow line is nothing but the investment money that will go to the mutual fund company. Now the mutual fund company which has collected money, let's assume, let's take a simple number to make you understand. Let's imagine for every 1 unit of mutual fund, the company is collecting 100 rupees. So if I assume investor A has invested 100 rupee, investor B has invested 200, and investor C has invested 300. Is it okay? Having looked at this, is it okay if I say A has purchased 1 unit of mutual fund, B has purchased 2 units of mutual funds, and C has purchased 3 units of mutual funds? All of you okay? I'll repeat it again. Do not get confused. Assuming every mutual fund unit cost is 100 rupee, right? A has invested 100, means A has purchased 1 unit of mutual fund. B has invested 200, B has purchased 2 units of mutual fund. C has invested 300, means C has purchased 3 units of mutual funds. So the total amount of money that is there with the mutual fund company right now is 600. And this mutual fund company, based on, understand this now, based on what they have told you, that is to the investor, have they told you that it is a debt mutual fund? If it is a debt mutual fund, they will invest most of this money into the debt instruments. If the mutual fund company says this is an equity mutual fund, most of the investments they will do it in the equity instruments. All of you okay with this idea? Debt mutual fund means, imagine I'll show you a very simple example. Imagine this is one mutual fund unit. Value is 100 rupee. I will give this to you. I will collect 100 rupees. And because this is a debt mutual fund, most of this money I will invest in the debt market. If this is an equity mutual fund, I will collect money from you by giving this mutual fund unit. Most of this investment, I will do it in the equity market. So equity mutual fund, debt mutual fund. And understand this, there will be different combinations. There will be different combinations. Right? Some companies will have 10 types of mutual funds. Some companies will have 5 types of mutual funds. Whatever names they are giving, don't worry. Whatever names they are giving, don't worry. Concept is simple. Either they are investing in the debt market or in the equity market, or it is a combination. It is a combination of both of them, right? So don't worry. Names could be different, but the concept is same. So now have a look at this, right? Have a look at this. The mutual fund company, let's say, will use this 600 rupees and will purchase, again, just a hypothetical example, will purchase 600 rupees worth of government bonds. Will purchase 600 rupees worth of government bonds. Now, simple question to all of you. If the market price of the government bond today is 600, do you think tomorrow also it will be 600 rupees only? After 1 month, it will be again 600 rupees, same 600. After 3 months, same 600. No. Some of you are saying yes. Interestingly, some of you are saying yes. Absolutely no, my dear. Bond market prices are fluctuating. Yes or no? Market prices will keep on fluctuating. So is it okay if I say, if the mutual fund company has invested in debt instruments and is holding the asset, these are assets now, the market price of the assets will keep on changing? Correct? Anybody has a difficulty? Bonds market price will keep on changing. That's a fact, by the way. I believe this is my 14th or 13th class. This should be very clear to you. On the other side, imagine they have taken 600 rupees and they've invested and purchased shares of companies. Equity market, shares of companies. Right now, again, same question. Do you think the market price of the shares will remain constant? No, market price of the shares will also keep on fluctuating. So now is it okay if I say whatever money has been collected by the mutual fund companies, whenever they invest in the assets in the market, the value of the investments will keep on fluctuating? All of you okay? The value of the investments will keep on fluctuating. Now, please tell me, have you seen mutual fund advertisements in the TV? Let me see. Have you seen the mutual fund advertisements in the TV? And now I hope you understand why they say mutual fund investments are subject to market risk. Let me know. All of you okay? Why do they say at the end of the advertisements, mutual fund investments are subject to market risk? You might be investing in an equity mutual fund, but that investment value will keep on changing. You might have invested in the debt mutual fund. That mutual fund value, that investment value will keep on changing because these are invested in the market. Market prices are fluctuating. Is it okay? Is the logic okay with all of you? Anybody has a doubt even now? Now come to the next point. Come to the next point. Let's say hypothetically, this 600 rupee has been invested either in the bond market or in the equity market or a combination. And today I'm the mutual fund company owner. I've issued one mutual fund unit to you and you paid 100 rupees to me. Your investment was 100. Imagine your investor A. Now, there are two types of mutual funds again here. There are two types. One is called as closed mutual fund and the second one is called as open mutual fund. Right? One is closed mutual fund and the second one is open mutual fund. What is this closed mutual fund and the open mutual fund? In closed mutual fund, if I issue this mutual fund unit to you, you cannot return it to me for certain fixed time period. Anybody has a problem? Let me know. If it is a closed mutual fund, I will sell this mutual fund to you. I'll collect 100 rupee from you. For one unit, I'll collect 100 rupee. but I'll say it is a closed mutual fund for 2 years, which means for 2 years, you cannot return the mutual fund and demand your investment back. You cannot do that. That is called as a closed mutual fund. And if it is an open mutual fund, I'm selling this mutual fund, I'm collecting 100 rupee from you. And if I say this is an open mutual fund, at any point of time, you can return the fund to me or you can return the unit to me and get the money. Get the money back. That is called as a closed as well as open. It's a very simple concept. Do not complicate it. It's a very, very simple concept. Closed means fixed time period, you cannot return units. Open means you can return units and get the money. But next point, imagine today you give me 100 rupee. It's an open mutual fund. Okay, imagine today you give me 100 rupee. After 1 week, you will return the mutual fund unit to me. How much money will I give it back? How much money will I return back to you? That depends upon what is the value of the assets held by the mutual fund. I'll repeat it. That depends upon what is the value of the assets held by the mutual fund after 1 week. Meaning what? Just imagine this. The mutual funds, it was a debt mutual fund. Okay. I issued this mutual fund unit to you. I collected 100 rupee from you, 200 rupee from somebody else, 300 rupee from another. Assuming 100 rupee per unit. You are investor A. So you have purchased 1 unit, you have given me 100 from another person, they have purchased 200, they have they have given 200, they have purchased 2 units, and third person purchased 3 units, has given me 300. So total money I've collected is 600, 300 plus 200 plus 100, 600. Now I'll take this 600, purchase a government bond. Purchase a government bond today at 600 rupee. After 1 week, there are 2 possibilities. After 1 week, the market price of the bond could be 660 or market price of the bond can be 540 as well. Market price fluctuates. It can go up or it can go down. Now, please let me know, is it okay if I say from 6 units, I've collected 600. Now, if the market price becomes a 540, can I say your mutual fund unit, if you return it to me, I will return 90 rupees to you? Let me know. Does it make sense or not? I collected I sold 6 units. I collected 600 rupees and per unit, how much money I've collected? Per unit, 100 rupee. So now using that 600, I've invested in the market. I have assets worth 600 rupees. But after 1 week, asset prices have fallen down to 540. Now you have come to me, you want to hand over, you want to surrender the unit. Will I give you 100 rupee back? No, I will not give you 100 rupee. I'll say market price, subject to market risk. So what I'll say, the investment has gone down to 540 now. So 540 divided by 6 units, per unit price will be how much now? 90 rupees. I will return 90. In fact, I will not return 90 also. Again, I'll impose charges on it because I'm managing the asset. I will withhold certain charges and return less than 90 rupees to you. What if it is 660? Now it is not 600, 660. So per unit price will come 110 rupees. Right? I'll return 110 rupees. Of course, I will withhold certain charges because I'm managing the assets. So this is how mutual funds will actually work in the economy. And please understand, they will also publish every day. Every day at the end of the day, they'll publish one value called as net asset value. Every day at the end of the day, they'll publish something called as net asset value, NAV, net asset value, NAV. Now, does it make sense to you when you understand the idea of mutual funds? Does it make sense to you if NAV of mutual fund company will keep on changing from one day to the next day? Think of it. NAV, net asset value, will keep on changing for the mutual fund companies. And those are asking why, how it can change. My dear, the market prices of the assets held by the mutual fund company. market prices of the assets which are with the mutual fund company, market prices will keep on changing. And when the market prices of the assets will change every day, net asset value will also keep on changing. So NAV, they'll call it as NAV, NAV, NAV. NAV of every mutual fund company is published at the end of the day. NAV will keep on changing, because the market prices will change. Portfolio will also keep on changing. All of you okay with how this model of mutual funds will actually work? Let me know. All of you okay with this? Now read the statement. Read the definition. Let me know, does it make sense or not? Mutual fund is a type of investment vehicle. It's a type of investment opportunity that is available for the investors, wherein the investment is held in the form of a collection of stocks, collection of bonds, etc. Portfolio means collection. Mutual funds give small or individual investors access to diversified means different. Diversify means different. Do not invest. For example, market mantra is diversification. Do not lay all your eggs in a single basket, they'll say. Meaning what? Whatever money you invest, do not invest in only one instrument. Do not invest in only one instrument. For example, just to make it very quickly clear to all of you, imagine you have 10 lakh rupees. What if you had invested all the 10 lakh rupees in the shares of Kingfisher company? Think of it. You will understand it very quickly. If I give you extreme examples, you'll understand it very quickly. Imagine you had 10 lakh rupees and you invested all the 10 lakh rupees in the shares of Kingfisher company. Right? Don't you think overnight your investments will become right? Negligible value will be lost, eroded completely. Rather than that, rather than investing all the 10 lakh in Kingfisher company share, what if you had diversified? Diversified means different investments you have done. Right? Some in Kingfisher, some in Tata company, some in Adani company, some in government bonds, etc. Diversification. Right? So diversified, professionally managed portfolios. Mutual funds are divided into several kinds of categories representing different kinds of securities, etc. But basic idea is simple. Either they will invest in bond market or in the equity market or a combination. That's a basic idea. Mutual funds will charge annual fees for maintaining the asset. They will charge annual fees and in some cases commissions, which will affect overall returns earned by the investors. Now please look at it. All of you okay? Why the mutual fund companies are generally part of asset management companies? Look at it. Right? Why mutual fund companies are part of asset management companies? All of you okay? Why these are called as AMCs, asset management companies? Because they're managing the assets in the form of shares, in the form of bonds for their investors. That's the reason these are also referred to as asset management companies or AMCs. Okay, done. Our next concept is ETF, exchange traded funds. Very technical concept, but we'll try to simplify this. Very technical concept. What is ETF? Look at it. An exchange traded fund is a basket, portfolio. Basket is nothing but portfolio. Is a basket of securities that trade on an exchange just like a stock. Now, many of you simply say, sir, what is this? Right? You are given one line definition, but it's very difficult. We cannot understand it. To make it easier for you to understand, I'll take a very simple example. Right? Can everybody see this packet? Let me know. Can everybody see this packet? What is this packet? It's a gems packet. Now, please do let me know, when you go to a shop, will you be allowed to purchase the whole packet or individual gems in the packet? Simple question, right? You will go to the shop. Are you allowed to purchase the whole packet or individual chocolates in the packet? All of you will agree? And everybody has purchased it. It's not like, sir, what is this? I've never seen gems in my life, etc. Right? So you will go to a shop. Either you will purchase the whole packet or sales will happen of the whole packet, which means now can I simply say buying and selling of the complete packet is allowed, not the individual units. Is it okay? Buying and selling of the complete packet is allowed, not individual units. Now apply the same logic to one more packet where share of company A, share of company B, and share of company C have been clubbed together like this. I hope you understand. Now imagine gems and shift to a similar example where there is one packet, there is one share of company A, another share of company B, and there is a share of company C. Now in the market, either you are allowed to purchase the packet completely or sell the packet completely. You're not allowed to break the packet. You're not allowed to open the packet. You're not allowed to change the packet also. Either you will completely purchase the packet or you will sell the complete packet. That's it. Which means now imagine you will purchase one packet. Imagine you will purchase one packet which has shares of A, B, and C. Can I call it as a basket of security? Let me know. Can I call this as basket of security? Anybody has a problem with? Anybody has a problem with this? Please do let me know. Can I call this packet where you will purchase, right? There's a share of A, share of B, and share of C. You'll purchase the complete packet. You will sell the complete packet. You cannot break the packet. You cannot open the packet, right? So you will purchase the complete packet or you'll sell the complete packet, basket, right? Can I call this as a basket of security? Now let me know. Similarly, can we do this for bonds also? This one is an example of equity. Can we do the same for bond also? That is, I will take bond of company A, bond of company B, and bond of company C. I'll prepare a packet. Now I'll sell this basket. I will sell the basket of bonds of company ABC. You will purchase a basket. You will sell the basket. You cannot change the composition. You cannot add anything into the basket. You cannot remove anything from the basket. Either you will purchase the complete packet or sell the complete packet. So it can be done both for equities also, can be done for bonds as well. The basic idea is this packet I'm referring to, this basket of instruments that I'm referring to is called as exchange traded fund. It is called as exchange traded fund. Basic concept. Anybody has a problem with this? Please do let me know. Anybody has a problem with the concept of ETF? Remember this jumps packet. Automatically you'll understand in the exam also. Remember this jumps packet. Automatically remember what is ETF. It is a basket of securities. It is a basket of security where instruments, different instruments are there. You will purchase the complete basket. You will sell the complete basket. Okay, that is called as exchange traded fund. Now, some of you are asking, sir, can we have a combination of both? That is shares as well as a bond. My dear, if it is a bond ETF, it is listed in the bond market. If it is, right, if it is a share ETF, it is listed in the stock market. Now, please tell me, if you put if you put forward a model where some of the shares are there, some of the bonds are there, where will you list them? Right? Where will you list it? Will you list it in the bond market or will you list it in the stock market? So as of now, right? As of now, we are simply having equity ETF. Whenever shares are there, it is called as equity ETF. And whenever bonds are there in the packet, it is called as a debt ETF. It is called as debt ETF. All of you okay? Can we go forward now? Can we call it as derivative? My dear, the packet has chocolate. The packet itself has chocolate. Packet is not deriving its value from something else. Understand my logic? The packet itself, if you open the packet, the chocolates are there, right? So it is not a derivative. It's a basic package of instruments. Is the logic okay? Okay. Anybody has a difficulty? The basket is called ETF or investment. My dear, basket is ETF. You will spend money to purchase a basket. That is investment. Some of the students, I don't understand from where will they get these kind of doubts. With the selling or buying an ETF, a basket of assets can be either sold or bought. ETF share prices fluctuate all day as the ETF is bought and sold. If it is a bond ETF, can be sold and bought, prices will fluctuate. If it is let's say equity ETF, again share prices will keep on changing. The prices will also change. When the ETFs are traded, the prices will change. These offer a diversified portfolio. Right? It's an opportunity for you to invest in a diversified portfolio. Okay, can we go forward? Can we go forward? In the context of ETF, I'll discuss three types. Government side, I'll discuss three types. There are more than 100 ETFs in India. I'll repeat the statement. There are more than 100 ETFs. You don't have to read all the 100 plus. Government related ETFs, there are three. Just remember these three. First two are equity ETF. First two are equity ETF. Now, what is these two equity ETFs? One is called as a CPSE ETF. Second one is Bharat 22 ETF. One is CPSE ETF. Second one is Bharat 22 ETF. Now, what is a CPSE ETF? If you purchase 1 unit of CPSE ETF, I repeat, if you purchase 1 unit of CPSE ETF, it will consist of shares of 12 companies. All the government owned companies, right? All of these are government owned companies. I'll repeat it. If you purchase 1 CPSE ETF, for example, I'll take this gems example. If you open this gems, imagine 12 gems are there, 12 chocolates are there. Instead of 12 chocolates, replace that in your imagination. 12 chocolates, replace that with shares of 12 companies. So this CPSE ETF will consist of shares of 12 companies, right? So launched in 2014, right? It was launched in 2014. Who is the asset management company for this CPSE ETF? Who will manage these ETF units in the market? It is Reliance AMC. Reliance AMC has issued this, right? These are the investors to whom they have issued. They have collected money, they have given it to government, etc. This is a right asset management company. Next one is Bharat 22 ETF. Bharat 22 ETF, straightforward. In the Bharat 22 ETF, there are shares of 22 companies. There are shares of 22 companies, and these 22 companies are from 6 sectors. Right, these 22 companies are from 6 sectors. Right, there are 6 sectors from which shares of 22 companies have been taken, clubbed together, and we are calling this as Bharat 22 ETF. Okay, and who is the asset management company for Bharat 22 ETF? It is ICICI Prudential. ICICI Prudential Asset Management Company. AMC is nothing but asset management company which manages, right, the Bharat 22 ETF. Everybody is okay with this? Can we go forward? Everybody is okay with this? What are those 6? Are not required, right? It's not required. If you want, you can get it in the website also. Not required as far as I'm concerned. Right, sir, which are these 22 companies? Which are these which are these 6 sectors? Why? Just understand the basics of it. Okay, let's go forward. Bharat Bond ETF. This is a debt ETF. This is a debt ETF. This is a debt ETF. Okay. Now, what is this debt ETF? Right? What is this particular debt ETF? Let's understand. Government of India back in 2020 issued Bharat Bond ETFs. Proposed the idea of a Bharat Bond ETF, and it has been implemented now. Now, what is this concept of a Bharat Bond ETF? Let me explain. In the Bharat Bond ETF, Government of India says it will be a basket where we are going to have bonds of public sector enterprises. It is a basket where we are going to have, right, the bonds of public sector enterprises. That is the companies owned by Government of India, their bonds. The bonds issued by these companies will be clubbed together, and that is right, a Bharat Bond ETF. Now, please understand there are different maturities. There are different maturities of Bharat Bond ETFs. That is, let's say you will purchase a Bharat Bond ETF 2030. What does it mean? In the market, you'll purchase Bharat Bond ETF 2031. What does it mean? You'll purchase in the market Bharat Bond 2024 ETF. What does it mean? Please understand this. Whatever is the date, whatever is the year, that ETF will consist of bonds which will mature in that year. I'll repeat the statement. Understand this carefully. If you purchase a Bharat Bond ETF 2030, if you purchase 2031, if you purchase 2032, what does it mean? The bonds which will mature in 2031 will be present in Bharat Bond ETF 2031. The bonds of public sector companies which will mature in 2030 will be present in the Bharat Bond ETF 2030. All of you okay with this? Anybody has a difficulty? For example, if you have a difficulty even now, let me give a very simple example. Imagine company A, public sector company A has issued a bond in 2030 which has a maturity period of 12 years. And company B, again public sector company, which has issued a bond in 2020 but has a maturity period of 10 years. Please tell me, can I say, if it is again hypothetically, can I say both of these bonds will be part of Bharat Bond ETF 2030? All of you okay with this? Both of these will be part of Bharat Bond ETF 2030. Anybody has a difficulty? Why? 2018 maturity period of 12 years. When these bonds will mature? 2030. 2020 maturity period of 10 years. When these bonds will mature? 2030. So Bharat Bond ETF 2030 simply means the company's bonds, all the bonds which are there in this ETF will mature in 2030. They might be released, they might be issued in different years, but all of them will mature in 2030. Right? 2032, different bonds are there. All of these will mature in 2032. That's the basic idea. Okay, so different maturities are there. We started with 2 maturities. Now it has been shifted to 4. Now even 5 maturities are there. 6 maturities are there. 32 is there. 33 is there. Different types, different maturities have been issued now. Okay. So it will invest in high quality AAA rated bonds. Now please do let me know this is okay with all of you. AAA rated bonds. Right? Any bond which has been issued by a public sector company, if it has to be included, in the Bharat Bond ETF, it has to have a AAA credit rating. If it has a AA, it cannot be included. If it has double B, cannot be included. If it has C, cannot be included. Only those which have a AAA credit rating are part of Bharat Bond ETF. Next, bond means annually coupon rate has to be paid to you. Bond means what? Annually coupon rate has to be paid to you. But in the context of Bharat Bond ETF, annually coupon rate will not be paid. Once the maturity period is over, that is, let's say Bharat Bond ETF 2030. 2030 is the maturity period. So once the maturity period is over, along with your principal, right, annual coupon rates, interest will be paid to you. Upon maturity of the ETF, not annually. That is basically the point. The fund will be managed by Edelweiss Mutual Fund Company. Asset management company will be Edelweiss Mutual Fund. Right? Can we go forward now? Anybody has a difficulty regarding concept of ETF? Exchange traded funds. Anybody has difficulty? It's a very simple concept. Do not complicate it. ETF represents basket. Simple. Basket. Basket of bonds. Basket of shares. Basket will be purchased. Basket will be sold. Not individual units. Can we go forward? So does bond market also work on demand and supply? Of course, yes. Whether it is a stock market, bond market, it boils down to basically demand and supply. Okay, done. Sir, if it is not derivative, how is gold ETF available at 500 rupees per unit? What is the problem there? If it is not derivative, how it is available? My dear, everything is available at a price. Then does it mean everything is derivative? This pen is available at 500 rupees in the market. Is it a derivative? I do not understand what is the logic behind it. What is the question there? Everything has a market price. So does everything mean derivative? No. Derivative simply means an instrument that will derive its value from something else. Derivative means it doesn't have any independent value. This marker, do you think it's a derivative? No, the marker has value. It is not deriving value out of something else. But what if I say, I will give you one instrument, this instrument will derive value, right, related to gold prices. That is, whatever is the gold prices, this instrument will derive its value from gold prices. Then it becomes a derivative, right? So understand the definition first. Okay, ETF and MF are both one and the same, my dear. Can you change your portfolio? Understand this. You're a mutual fund company. Can you change your portfolio in case of mutual funds? Let me know. Can you change your portfolio if you're a mutual fund company? Think of it and do let me know. From one day to another day, can you change a composition of your assets? Can you change the composition of your assets? Of course, yes. Today you will have 600 rupees, you will purchase government bonds. Tomorrow you can sell it, purchase at corporate sector bonds. So composition can be changed if you're a mutual fund company. Listen first. Listen first. If you're a mutual fund company, you can change the composition of your asset. Tell me now. This is an ETF. This is an ETF. You purchased it. Can you change its composition? Let me know. Can you change the composition of this ETF? Can you change it? No. Some of you are saying yes. How? Tell me how. Tell me how can you change the composition of this packet? I don't understand how you people actually think sometimes. Right? I don't understand. You will either have to sell this or purchase it. You are not allowed to alter it. Right? That has been the point that I've been shouting for the last 15 minutes. I've been shouting at my pitch. You cannot alter the composition. Either you purchase it or sell the whole packet. That's it. No, sir. I'll tear it and open. Congrats then. You have not understood what is ETF. And if you say, sir, I'll tear it, I'll take this, I'll do that, etc. Congratulations. You have not understood what is ETF then. What is the concept of ETF? Purchase the whole basket, sell the whole basket. You cannot change the composition. But in a mutual funds, yes, you can always change the composition. Okay. Anyways, last concept in this chapter, corporate bond market. Corporate bond market. What has been the issue in the corporate bond market? Right? If you remember earlier, I told you this point, today we'll discuss. I stated corporate bond market is not very well developed in India. Correct? Corporate bond market is not very well developed in India. I've told you this statement. I'll tell you the context also. Go back to the slide of NABFID. Go back to the slide of National Bank for Financing Infrastructure Development. In the concerns regarding the model, I said corporate bond markets are not developed in India. And NABFID is supposed to issue bonds and raise money. So because the bond market is not very well developed, it is a cause of concern, I said. Now come to the reason. Why? Why corporate bond markets are not very well developed in India? Point number one, retail investors such as you and me, we are more interested in government bonds, safety. We are more interested in the stock market because we feel we can make huge amount of money in the stock market. That is a precise reason. Investor base is very small, very narrow in the corporate bond market. Is it okay? Retail investor base is very, very narrow in the corporate bond market. That is first reason. Second reason, the primary and secondary bond market for government bonds is very well developed. Primary and secondary market for shares is developed in India. We do not have very well developed secondary market for corporate bonds. I'll repeat the statement. We do not have a very well developed secondary market for corporate bonds. And many of you will start asking me, what is this idea of a secondary market in corporate bonds? Imagine you purchase a bond from the company in the primary market. You want to sell it. You want to trade it. There is not a very well developed secondary market for it. And don't you think, right, that is a liquidity feature? Don't you think because of this lower liquidity feature, demand for corporate bonds generally will be lower. And between the government as well as the private sector, investors, be it retail investors, be it institutional investors, they always have more security, more faith on government. And that is the precise reason most of the bonds in India, more than 70% of the bond market, the value of these bonds are of central government as well as state governments. Is it okay? More than 70% of the bonds which are issued in India are of either the central government or state government. Private sector accounts for very, very less, right? Less than 30%. So first one, low penetration. Most of the bonds issued in Indian market are government bonds. It could be central government bonds. It could be state government bonds. And whenever you talk about state government bonds, please remember the technical term. State government bonds are referred to as state development loans. State government bonds are technically referred to as state development loans, SDLs. Please remember the technical name. Central government, we directly call them as government bonds, right? Central government bonds. Whereas state government bonds, we'll call them as state development loans, SDLs. Okay, so very low penetration. Secondary market, liquidity is very low. There is no development of a very good secondary market in India. And that is a precise reason demand for corporate bonds in the primary market is lesser. Third one, investor base is very narrow. Retail investors are more interested in government bonds. They're more interested in the stock market, not so much interested in the corporate bond. Fourth one, repo operations. Now, please tell me, a bank would want to borrow from RBI. Don't you think if a bank wants to borrow from RBI under repo, they will use government securities, not corporate bonds? Correct? Yes or no? Anybody has difficulty? Right? Go back to repo, you'll understand what I'm talking about. If any bank wants to use repo operations, they will use government bonds under repo operations, not corporate bonds. So automatically, all the banks who want to borrow from RBI, they will keep on purchasing government bonds to use them under the repo operations. And diversity, right? Different types of varieties of the bonds, it is lesser in India compared to global market. In global market, there are various types of bonds, various types of bonds, different varieties of bonds for different investors. Whereas in case of India, although some of you will simply say, sir, but there is a green bond. Green bond has become very famous very recently in India. Government of India started issuing it in the last 1 year. Right? What about sovereign gold bond? Starting 2014. Additional tier 1 bond after Basel III guidelines. So varieties of bonds, different varieties of bonds which would cater to the needs of the investors. The variety development is lesser in India compared to global market. So these are some of the reasons why corporate bond market is not very well developed in India. Now, what reforms have been undertaken by Government of India as well as RBI to promote corporate bond market? Right. First one, green bonds are being promoted now. Correct. Government of India itself is issuing green bonds to promote more and more different varieties of bonds. What about masala bonds? Right. RBI is promoting it. Government of India is promoting it. Additional tier 1 bonds, tier 2 bonds. So different types, new types of bonds are being issued in the Indian market to attract different types of investors in the market. Second reform, targeted long-term repo operation. Targeted long-term repo operation, TLTRO, targeted long-term repo operation. Now, what is this targeted long-term repo operations? Let's understand it. Under TLTRO, RBI provides this facility where banks can borrow for a duration 1 to 3 years from RBI. I'll repeat the statement. Targeted long-term repo operation. It's basically a facility. It's a type of facility provided by Reserve Bank of India, where banks can borrow from RBI from 1 to 3 years. From 1 to 3 years. Now, what is the use of this borrowing? RBI says whenever you borrow under TLTRO, you will have to use this money to invest in corporate bond market. You cannot use it for any other purpose. You can use it to purchase bonds from the corporate bond market, right? And not just any corporate bond, only those corporate bonds which will have an investment grade, And if you remember earlier, investment grade means anything that is equal to triple B or above triple B, it is called as an investment grade. So a bank is allowed to borrow at repo rate under this TLTRO for a duration 1 to 3 years, but they will use this money only to purchase corporate bonds from the market of investment grade. Now, very, very simple question to you people. If this kind of facility is availed by the banking sector, don't you think automatically the demand for corporate bonds will start increasing in India? Let me know. The demand for the corporate bonds, don't you think automatically will increase? That will promote growth of corporate bond market. That will basically promote the growth of corporate bond market. Okay, so these are some of the reforms that have been implemented very recently in the context of corporate bond market. Okay, now these are the references. Many of you are asking for references. Sir, from where can I read this? I'll give you a very important point here. These are the references, but a lot of these points that you have discussed in today's class as well as the last class are from current affairs. You may not find this in a textbook. Don't worry. It is from current affairs. For example, short selling. You may not find that in a book. Right? For example, sovereign gold bond. Very novel concept in India. You may not find in a book. Right? Or let's say concerns raised by Government of India regarding sovereign credit rating. You may not find that in a book. Lot of these concepts are from current affairs. So if it is not there in the book, it means it is there in the current affairs. Okay, so NCERT book as well as Tamil Nadu board book, right? So these are the different sources. Use them, read. I would advise you people to read. Either NCERT or Tamil Nadu book, doesn't matter. Please read. Right? That is more important. Please read it. Okay. Okay. Now, let me solve the questions from budgeting. Budgeting last week, descriptive questions were left out. Let's solve it. Then let's take up MCQs. Sir, you said secondary market for corporate bonds is not developed, but NSE, NSA are very high share of corporates. My dear, BSE and NSE is a share market. Read. That's the reason I'm saying at least observe in the newspaper. No, when you come across BSE and NSE, is it a debt market or is it a stock market? Read. It is a stock market. So when you say stock market, these are very well developed secondary markets for shares, for equities. Okay. Now, descriptive question in earlier chapter. The public expenditure management is a challenge to the government of India in the context of budget making during the post-liberalization period. Clarify. Now, what is this post-liberalization period? That is basically post-1991. We'll discuss later in the chapters. Other chapter, you will understand why 1991, right, is important. That was the year when we started implementing reforms. Right? That is the reason post-liberalization means post-1991. Why budget making is a challenge, right? Understand. These are some of the reasons. First one, fiscal deficit is a problem. It's a challenge for the government. Everybody will agree. Sir, why? Why fiscal deficit is a challenge? Government of India has to provide for welfare. Government of India also has to provide for infrastructure expenditure. So if they keep on providing without any control, fiscal deficit will increase. And whenever fiscal deficit increases, there is one more challenge that is called as crowding out. Understand the technical meaning of it. There is one more challenge, one more outcome called as a crowding out. What do you mean by crowding out? Crowding out simply means the borrowers will move away from the market. The borrowers will move away from the market. It is called as crowding out. Now, many of you ask me, sir, why does the crowding out happen? Why does the crowding out happen? Understand the logic here. If government of India's fiscal deficit increases, can I say government's demand for money in the market will increase? Listen carefully. If government of India fiscal deficit increases, can I simply say government is demanding more money in the market? Now, please tell me, if government will start borrowing more money, demand more money, don't you think interest rates in the market automatically will start increasing? Think of it and do let me know. Right? If government's fiscal deficit starts increasing, what will happen to interest rates? Interest rates automatically should increase. More demand, right? The lenders will charge a higher rate of interest. That is logical. Now, if a company wants to issue a bond, can they offer a lower coupon rate? Can they offer a coupon rate of 5%, 6%? No. The market will demand a coupon rate of 7%. Market will demand a coupon rate of 8%. Why? Demand for money is very high. So don't you think now private sector companies, if they want to borrow, will have to offer a higher coupon rate? Will have to offer a higher interest rate? That might force borrowers to move away from the market. That is called as crowding out. Borrowers will move away, crowding out. Challenges of globalization, global shocks. If there is right, let's say a war, if there is a war between two countries, right, can this disrupt oil supply? Can this disrupt fertilizer supply? And can government of India, because of this, don't you think government of India's revenues would be affected? Anybody has a problem? Government of India's money that government of India has, that would automatically be affected, right? That is basically the argument of the subsidies. Government has to provide more subsidies. Government has to provide more and more subsidies, right? So government's revenues would also be affected. Narrow tax net, lot of tax avoidance, tax evasion, that is also challenge. Capital expenditure requirements are very high, that is also challenge for government of India. And welfare policies, welfare measures, right, announced by the government. For example, Revdi culture. Government of India calls this as Revdi culture, right? So welfareism. Whenever governments will provide lot of these, let's say the welfareist policies, free electricity, free bus ride, etc. That will also lead to a lot of expenses without any revenue collection. So these are some of the challenges faced by the government post 1991. So to address these kind of concern, what kind of measures have been implemented by the government? One, FRBM Act has been implemented. All of you remember FRBM? Under the FRBM Act, government has to reduce RD to 0%, FD to 3%. Government cannot borrow directly from RBI. That will lead to inflationary trend, etc. We have merged a railway budget with union budget. I've discussed this earlier also. Right, earlier we had two separate budgets. Now, right, no requirement of two ministries, only one ministry, finance ministry will take up the budget. Subsidies, right, I think I gave you example of LPG subsidy for rationalization. LPG subsidies have been rationalized. Many other subsidies have been rationalized now. That will reduce the expenditure, revenue expenditure will reduce. And the government also set up a public financial management system to keep a track. PFMS is a system. It is a portal in simple terms. Government of India on real-time basis, on right periodical basis, day-to-day basis, they can keep a track how much funds are going to state government, which scheme is taking how much money. Under this scheme, how much has gone to the state government, which beneficiary is covered. All of this information can be tracked under the PFMS. So these are some of the measures which have been taken by the government to make public expenditure management much more effective. Okay. Next is a straightforward question. Distinguish between capital budget and revenue budget. Explain the components of both of these budgets. We have discussed this earlier. What are the components under revenue budget? What are the components under capital budget? How do you define what is revenue account? What is capital account? We have discussed all of this earlier. Same thing I've written in the slide also. Please go through this. Okay. Next question. Women empowerment in India needs gender budgeting. What are the requirements and status of gender budgeting in India? Right? Explain or discuss. That is a question, 250 words. Now, you can write introduction. Do not write a very lengthy introduction. Keep it very straight, very short. Gender budgeting as a concept was introduced from 2005 and 2006 in India. What is the need for having a gender budget? It is the duty of the government. The policies of the government should not increase inequality. They should be used to reduce inequality. Gender budgeting will help in women empowerment, that will reduce the incidences of violence against women, etc., etc. We have discussed all of those under the need for gender budgeting. Okay. Then what is the status of gender budgeting? What is the status of gender budgeting in India? We have two types of schemes under gender budgeting: scheme A, scheme B. Right, in one of them 100% scheme A, 100% of the funds are allocated for women beneficiaries. Scheme B, at least 30% of the funds are allocated. So most of the funding under the gender budgeting goes for scheme B. We should increase the allocation under scheme A. Various ministries are yet to bring out more schemes or cover more of their schemes under gender budgeting. Funds have been allocated, utilization rates are very low, right, etc. So these are some of the points regarding the current status of women budgeting or gender budgeting in India. Okay, done. Right, so these are the descriptive questions which have appeared from the concept of budgeting. Some of the MCQs are left out from the financial market, that we'll take up tomorrow. We'll discuss MCQs from financial market tomorrow. Okay, any questions that you people have, let me know so that I can discuss, resolve, and then we can stop the discussion. Sir, bonds can be traded BSE and NSE. My dear, whenever you say BSE and NSE, these are generally stock markets. Within BSE, BSE is a unit. BSE is a company, just like a company. They have a different unit under that, that is a bond market. They have a different circuit for bond market. If you see stock market, right, please do me a favor, go to stock market or simply type BSE stock market. They will not give you information regarding bond. Different within BSE. BSE is a company, by the way. Within BSE, there is one more branching which is called as a bond market. Bond market is a separate circuit. Stock market is a separate circuit. Okay. Economics is good or not for optional subject? Please pick up economics only if your background is economics. And there also, right, go through the syllabus once. Go through the syllabus. Paper 1 is very, very technical. Do not take up economics as an optional just because you have a background. I said condition is that you should have a background of economics. If you're finding GS paper 3 difficult, Indian economy difficult, then stay away from economics as an optional. Okay. Sir, if any private interest, I've addressed this. How many times you will ask the same question? What is utility of masala bond? The issuer will not face the exchange rate risk. Which one will give higher return? Stock market or mutual fund? My dear, there is no guarantee where you're going to earn higher return. Mutual funds are type of investments which are available for investors who want to invest small amount of money. Those who do not know how to operate in the market. So the use of these two instruments are different, right? So sometimes you might get more returns in the stock market. Sometimes you might get more returns in the mutual fund, because it depends on where have you invested, in what instruments have you invested. There is no fixed answer for that. Okay. How is sociology for optional? My dear, I'm economics faculty. You are asking me about sociology optional. I don't know what is the syllabus. I don't even know what is the syllabus of sociology. Okay, beverage curve basically represents, it's a curve. It's a graphical representation which makes a representation of availability of jobs. Okay, done then. So let me stop the discussion today here. Tomorrow we'll continue the discussion. Okay, tomorrow we'll start with a new chapter, that is international trade. We'll solve the questions of financial market also tomorrow. Okay, so take care. See you tomorrow. And I've asked you to read the newspaper articles from today, yesterday also. Please read those articles. And all those articles are very, very important. Okay, so that's it. And I hope all of you have read the articles that I gave as an assignment in the last week. Friday, I had given you around 10 plus articles. I hope all of you have read those articles. Okay, so take care. See you tomorrow sharp at 6 a.m. Right? Good day.